Hello dear students, I hope the audio and video is clear and also the screen sharing is clearly visible. In this session for about next 2.5 hours, we will be taking up some of the MCQs from the recent case scenario booklets. I will be solving as if I am solving it in the examination. Most of the new MCQs I have not seen through, okay. Even some of the older MCQs I would not have been seen, I would not have gone through. So what we'll be doing is, in a typical exam scenario, how should you read the MCQs, how should you solve it, shortcut tips, where we can avoid calculations, all of these things would be covered. We'll try to cover maximum of the case scenario MCQs. If at all, you want me to solve any other MCQ, you can just drop in the comment section, sir, we want this particular case scenario number on Monday or Tuesday, I will take them as well. Alright. So without wasting any further time, alright. So case scenarios we get in the examination, and a brief scenario is given followed by 3 or 4 MCQs or 5 MCQs in some cases. So let us see how do we read it. Now one thing before I start ahead, in the examination we should be taking up, or you should be trying to do the MCQs in the first hour itself. A lot of time I have seen students, they try to do it in the mid or towards the end. But the challenge there is, if your main paper doesn't go that well, you will be stuck or you will be stressed and you will not be able to give your best in the MCQs. And because MCQs are, each question carries just 2 marks, I think, it is worth the risk to start it with the MCQs for the first 45 minutes before moving on to the remaining questions. Now, when we get a question in the examination on case scenario, this applies for IBS as well. Whenever you get a case scenario, first thing is you see what is the question asking. So here, what amount would they account for liability related to contingent liability and asset, impact on goodwill. Suppose the fair value is changed than the value of liability, impact of goodwill, and amount of indemnification asset, right. So these are the questions. Let us read the scenario first. So once you have clarity of what the question is asking, what you should be doing is, as you read the question, try to at least underline or write in your rough note what could be the answer. ABC is a company engaged in strategic acquisition. This is not relevant. As a part of growth strategy, it acquired, not relevant. This acquisition presents growth opportunities, not relevant. So when you read this, does it help you to calculate any answer? No. So what you should figure out is, this is extra noise which you should just ignore. Means you can just do a quick skimming, but you don't need to spend too much of time to read this. Alright. Then following acquisitions took place during the year. ABC acquired a beverage company PQR Limited from XYZ Limited. So ABC acquired PQR from XYZ, selling company, buying company. At the time of acquisition, PQR is the defendant. Defendant means against whom a case has been filed in a court case where certain customers of PQR Limited have alleged that product PQR Limited contain pesticides in excess of permissible limit. So what is the summary? There is a court case. PQR is being sued for damages of 2 crores. XYZ has indemnified ABC for the losses due to the case for up to an amount of 1 crore. Fair value of contingent liability is 0.07 crores. Now, whenever we talk about business combination, what we have seen, any contingent liability, even though it has not been recognized in the books of the selling company, we will recognize it at fair value. Sometimes the selling company says that, okay, to the extent of some amount, we will compensate you or we will refund you. In that scenario, what you should be doing is, to the extent of contingent liability. So here they have said, we will refund 1 crore. But how much is our liability? 0.7 crores. So my indemnification asset should not be more than my contingent liability. So in this case, what will happen? My contingent liability will be 0.7 crores and indemnification asset will also be 0.7 crores. At what amount should ABC account for identified liability related to contingent liability and indemnification asset? We just now saw 0.7 and 0.7. What will be the impact on goodwill? If I am recognizing a liability, and of the same amount if I am recognizing an asset, the impact on goodwill will be nil, 0. Here, not here, here, 0. So net impact on goodwill will be nil. Suppose in case the fair value of identified liability is 1.2 crores instead of 0.7 crores, what will be the value of liability? Liability will be 1.2, indemnification 0.7, 1.2 Oh sorry, not 0.7, my bad. Maximum they have said that they will give 1 crore of indemnification. So 1.2 and 1 crore. So this is the number. What will be the impact on goodwill? Now here is the thing. My liability is increased net by 0.2 crores. With that amount, my liability will be net higher. If liability is higher, net asset will be lower. If net asset will be lower, then what will happen? Goodwill is equal to my purchase consideration plus NCI minus the identifiable net asset. If this number is lower, my goodwill will be higher. By what amount? 0.2 crores. So will it increase or decrease? Increase. So always remember, if the liability increases, the goodwill value will increases, the goodwill value will also increase, because on one side you are increasing the liability, corresponding the asset also has to increase. Alright, then ABC pays 50 crores to acquire RST from MN Limited. RST manufacture product containing fiberglass and has been named in 10 class actions concerning the effects of this fiberglass. MN Limited agrees to identify ABC Limited for adverse result of any court cases up to an amount of 10 crores. So what is the maximum indemnification amount? 10 crores. Okay. The class actions have not specified amounts of damages, and past experience suggests that claims may be up to 1 crore. So what are they saying? Claims will be up to an extent of 1 crore, but that are often settled for small amounts. Okay. Claim can go up to 1 crore but settle for small amount. ABC makes an assessment of the court cases and decides that due to the potential variance in outcome, contingent liability cannot be measured reliably and no amount is recognized. Okay, so all this story, basically what they are saying, we are not recognizing any contingent liability. If contingent liability is equal to 0, indemnification asset will also be equal to 0. So what is the question? What amount should asset be accounted? 0. Okay, so here 0.7 net impact will be nil, 1.2 and 1, 0.2 increase and nil. Alright. Then next one. Next question. Choose the most appropriate answer to question 1 to 5 based on the following mentioned fact. Okay. So now here see, this is a very small case scenario. So you can quickly see, okay, they have given date, they have given the amount, and they have given an asset. Asset acquired, indicators of impairment, classified as held for sale, fair value less cost to sell, and fair value less cost to sell. Okay. The amount of depreciation on the asset for year 8 would be how much? Now what happened? 1st of January of year 6 they purchased. Then 31st December of year 7, indicator of impairment. 20th February of year 9, classified as held for sale. They have asked us about year 8. Now what will happen? Life is 10 years. So what you have to do? 7,500 is the cost. And see, you don't do a detailed working for this. Even if you are able to do in a rough work, that will save you a lot of time. 7,500. Residual value they have not given. So depreciation for the first year, year 7 will be how much? 750. So 7,500 minus 10% is 6,750. Okay, directly you can do it. Then on 31st December of year 7, so we charged depreciation for year 6. Oh, it is 31st of December of year 7. So 2 years depreciation we should charge. That should be 1,500. So the amount will be 6,000. See, sometimes we can also make mistakes like this, silly mistake. Right. Now they have asked us for year 8 what will be the depreciation. Will the depreciation change for year 8? It will change. Impairment has happened on 31st December of year 7. So you will reduce the impairment amount of 240. So 6,000 minus 240, you get 5,760. 2 years have been completed. How many years are left? 8. Divided by 8. Depreciation is 720. Depreciation will be 720. That is one thing. Okay. Now, if you want to do it in a shortcut way, impairment is 240. So 240 by 8, 30 will be reduced from the depreciation every year. So 750 minus 30, 720. That also can be a cross check. On 20th February of year 9, asset has been classified as held for sale. So here after charging depreciation 5760 minus 720, how much is this? 5040 is the carrying amount on 31st of December of year 8. Alright. Now 2 months have been completed. Let us see what is the question. Amount of depreciation for year 9 would be how much? Now for year 9 if you ask me, the depreciation per year is how much? 720. After you have classified an asset as held for sale, you will not charge depreciation, that we all of us know. But we have used the asset for 2 months, January and February. So 720 divided by 12 into 2. So 720 divided by 12 into 2, 120 will be the depreciation, right? So this is one thing you have to keep in mind. Don't mark nil, as they have not anyways given nil. 120 is the amount of depreciation for year 9. So year 8 the balance is 5040 minus depreciation 120, 5040 minus depreciation 120. My carrying amount is 4920 on 20th February of year 9. What will be the carrying value of asset immediately before its classification as held for sale? Immediately before its classification, 4920. I hope the answers are correct. Yes. Okay. What will be the carrying value of the asset immediately after its classification as held for sale? Immediately after classification as held for sale, you will compare 4920 and 4600. So it is lower, 4600 will be the value. What will the amount of reversal of impairment loss and the carrying value after the reversal of impairment loss on 30th of June? Now what happened on 30th of June? They have still continued to classify it as held for sale. Now when I reverse it, maximum reversal will be to the extent of this carrying amount. I cannot show the asset at a value more than the previous carrying amount. Now don't get confused between impairment and 105. In case of Ind AS 36, you will continue to charge depreciation, but in case of Ind AS 105, you will no longer charge the depreciation. So depreciation stops there. Okay. So what will be the value? What will be the amount of reversal after, and what will be the carrying value? So carrying value maximum will be, okay, so I missed this point here. We have charged 240 of impairment loss also. Okay. So 240 of impairment loss plus here impairment loss was how much? 4920 minus 4600, impairment loss is 320. Okay. So 320 is impairment loss here, and we have charged loss of 240 earlier also. So total impairment loss is 560. Maximum reversal will be 560. So 4600 plus 560, 4600 plus 560, it is 5160. So maximum amount will be 5160. This will be the answer. Okay. So in a flow, I missed to reverse this particular indicator of impairment. Now here, one thing in the examination, what can happen is, you will start thinking that we should compute the carrying amount as if impairment was not charged, and after charging depreciation. That should not be done, because once it is classified as held for sale, you will no longer charge any further depreciation. Okay. So that is one thing you have to keep in mind. I also, unless I had seen the option and also the answer, it was also confusing for me for the first instance. Next, M Limited is engaged in production of agricultural activities. So this is again a description. You can skip it unless the you see that introduction will carry some answer. As per Ind AS 34, read with Ind AS 2, what will be the amount of fixed production overhead allocated to actual production and the amount of expenses to be debited or credited to P&L by the end of the first quarter. So they are asking Q1 information here, end of second quarter, Q2, revenue to be recognized, biological asset, and gain or loss on fair valuation of biological assets. So there are multiple standards question from multiple questions from multiple standard. Fixed production overhead for the financial year is how much? 10,000. Normal expected production for the year after considering plant maintenance is considered to be 2,000. It is considered at no quarterly seasonal variation. Expected production for each quarter is 500. The fixed production overhead for the quarter is 2,500. So 2,500 by 500, you get 5. Same thing, 10,000 divided by 2,000, also you get 5 per metric ton. Now we also know, as per Ind AS 2, if the actual production is more than the plant production, then what we should do? We should revise our overhead recovery rate. This we have already discussed in the class multiple times. First quarter actual production is 400, second quarter it is 600, third quarter 500, fourth quarter 400. Now if you see, first quarter is 4, second is 6. So here it has become higher, here it is normal, here it has become lower. Now another thing you have to keep in mind is, for the purpose of inventory and also because it is an annual plan, Every quarter we have to check it on a cumulative basis. Okay. There are no quarterly or seasonal variation. Alright. Now, as per Ind AS 34, what will be the amount of fixed production overhead allocated to actual production and the amount of expenses debited or credited to P&L by the end of the first quarter? Now, what is our overhead recovery rate? 5. What is our production? 400. 400 into 5. 2000 we will add it to inventory. 2000 capitalized to cost of inventory and balance 500 will be debited to P&L. Simple and straightforward. What will be the amount of fixed production overhead allocated to actual production and the amount of expenses to be debited or credited by the end of the second quarter? Now, when we come to the second quarter, what we have to see is not that 600 is there and we have to recompute. We should not do it that way because the plan is annual plan. So, you see up to second quarter, what is the output? 1000. 1000 is the output. Multiplied by 5, we have to debit 5000 to the cost of inventory. Okay. Now, 5000 should go to the cost of inventory. So, 5000 will be capitalized to cost of inventory. Now, how much amount will be debited or credited to P&L? By the end of second quarter, 5000 should be inventory and 0 should be P&L totally. Now, do not mark 5000 and 0 because in the first quarter we have 500 debited to P&L. That we have to reverse now because total amount to P&L should be 0. So, the answer is 5000 capitalized to cost of inventory and 500 debited credited, 500 credited to P&L. Okay, because current quarter inventory value is only 2500, actual production overhead expense. 2000 you have booked in the first quarter, you have to book one more 500 by reversing the amount that you have charged to P&L. Am I clear? Third, what is the amount of revenue to be recognized? And by the way, this is there in the recent RTP also. Okay. On 1st April, M sells gym membership of 7500 per member for first year to 100 customers with an option to renew at a discount in second and third year at 6000 per year. M Limited estimates annual attrition rate of 50% each year. So, what are they saying? Actual gym membership is how much? 7500 per member. To how many customers? 100. And what is the question by the way? What is the amount of revenue to be recognized per membership in the first year and the amount of contract liability per membership against the option given to the customer for renewing the membership discount. Okay. So, what have they given? They have given that 7500 per member they will collect, okay, from 100 customers. Option to renew it at a discount in second and third year at 6000 per year. M Limited estimates an annual attrition rate of 50% each year. Now, what is the meaning of this? 7500 is your normal thing. 100 is who will join year 1. Year 2, 50% will go. Okay, how many are left? 50 will be left, correct. Year 3, 50% will go further. How many are left? 25 are left. So, total enrollments if you see is 175. Total enrollments is 175. Now, please understand, because I have collected 7500 here, subsequent I am able to give them at a discount of 1500. So, I will give them at a discount of 6000. So, we are giving some material benefit to the customer. Okay, we are giving some benefit to the customer and total that is going to happen is 175. Now, how much will we collect? 7500 into 100 and 6000 into 75. So, 7500 into 100, 7,50,000. Sir, why 75? Shortcut, 50 and 25. 6000 into 75, 4,50,000. So, totally we will collect 12 lakhs from 175 enrollments. So, divided by 175, what will I get? 12 lakhs divided by 175 will get 6857.1 per membership. So, in the first year for every enrollment we will charge 6875 as revenue and balance amount will be shown as contract liability. So, do we have that option? Yes, option number C. Is it correct? Option number C is absolutely correct. There is the same question is there in the study material as well. Next, on 1st of November, M Limited purchased 100 goats of a special breed from market at 10 lakhs with a transaction cost of 2%. Goats fair value decreased from 10 lakhs to 9 lakhs on 31st March. Now, they have not said whether it is for agricultural activity or for what is the purpose. We will assume it is an agricultural activity. Purchased 100 goats, and what is the question? What is the amount of asset to be recognized on date of purchase? Come on, what is the value? Fair value less the cost to sell. Okay. So, what is the fair value? Fair value is 10 lakhs, transaction cost of 2%. Have they given any cost to sell? Now, they have not told 2% is cost to sell or cost to purchase. See, there are two things. It is possible that the buyer pays this transaction cost. Okay. It is also possible that the seller has to also incur transaction cost at the time of selling. That information is not clearly given in the question. This transaction cost, whether it is buy side or sell side, they have not given. Fair value is 10 lakhs, that is absolutely clear. So, what we should do? Let us see at the option. Now, possible that 10 lakhs also can be the answer, because I do not know transaction cost is buy side or sell side. But if I assume at the time of selling also I will incur the transaction cost, then the value will be 9,80,000. It cannot be 10,20,000 because it is always at fair value minus cost to sell. Even if I pay the cost, I will record it at fair value less cost to sell. Then the value has come down to how much they have said? The value has come down to 9 lakhs. So, what will happen? 9 lakhs means, what is the amount of gain or loss to be recognized at the time of valuation of the biological asset at the financial year end of 31st March of year 2. So, 9 lakhs is the fair value. So, 2% of that will be 18,000. 9 lakhs minus 2%, 8,82,000 minus 9,80,000. If I do, I get 98,000. So, this much of loss will be recognized. I hope it is clear. I am also solving like I am solving it in an examination. Okay. So, here and there could be something which I may miss out, which you should not miss out in the examination. Next one, this is a standard Ind AS 2 question. Okay. It has been tested as at inter also, at final also. Let us see. P Limited is a multinational company. I think you can attempt it on your own, because this is the same to same repetition, but still what all things to be ignored while solving, we can at least discuss that. P Limited is a multinational company and prepares and presents its financial statement following Ind AS. Okay, so again this is not relevant for us. They have opening inventory of 1000 goods, 1000 units, same to same, in numbers are also same. Raw material 1100 and purchase is 10,000, sales is 10,000, closing of 900, finished of 1200. Now, here always remember we need to know what is the production number. Okay. Now, the formula is opening stock plus production minus sales is equal to closing stock. Opening stock is how much? 1000. Production is how much? We do not know. Sales is how much? 10,000. Closing stock is how much? 1200. So, production is equal to 10,000 plus 1200 minus 1000. Production is 10,200. Same thing you can reconcile with the raw material. No need to reconcile in the exam. Okay. 1100 is the opening material plus purchases 10,000. Okay. Minus production 10,200. So, 10,200 plus 1100, 10,200 minus 1100 minus 10,000, if we do, we get 900. So, this is reconciled. Okay. But again, in the exam you do not need to reconcile, but if these numbers change, you definitely have to cross check once to see if there are any losses or not. Okay. And also raw material cost, if you see, here it is 1100 into 10, here also it is 10,000 into 10. So, average cost of raw material is also 10. If these numbers are different, then you may have to take either on a FIFO assumption or a weighted average assumption, calculate the value. Okay. Expected production was 15,000 kgs. Due to fall in the market demand for sales price, finished goods was sold at 20 per kg, replacement cost of raw material was 9.5 per kg. Calculate the closing inventory on that date. See, they have not even changed this. Calculate the closing inventory. Okay. What is there in the MCQ then? What is the total cost of production during the year? Now, cost of production means raw material is 10 rupees, labor 76,500 divided by 10,200, 7.5, overheads 75,000 divided by 15, 5, right. So, what did it say? Acha, they anyways ask total cost, no. So, total cost means what? 10,200 into 10 plus 7, 17, 17 plus 5, 20, 22.5. Okay. So, that number comes to 229,500 for me. So 229,500, let us see if there is an option. Yes, 229,500. Now you may miss what I have written on the screen. So what I did is, for on a shortcut basis, 10 rupees, 7.5 and 5, I have added all of this, multiplied it by 10,200. That is how you can save time. Okay, first question. Then, what is the value of closing inventory of finished goods at the end of the year? Now finished goods are valued at lower of cost. Cost is what? 17 plus 5, 22.5. They have said market price is 20. So 20 into 1200, straightforward, 24,000. No problem there. Then, what is the value of closing stock of inventory of raw material at the end of the year? Please remember, it is cost or replacement cost, whichever is lower. Don't blindly take replacement cost in the examination. So cost or replacement cost, whichever is lower. 900 units into 9.5. 900 into 9.5, we get 8550. Then comes next. P Limited made a security deposit whose details are described below. Market interest rate for deposit is 12%. Date of security April 1, date of security 5 years, and discount rate is 12%. They only have given. Okay. Security deposit 1 lakh, present value factor at the end of fifth year is 0.567427. Now here what does mean? As per Ind AS 109, if we have made some deposit, we have to do the fair value of the deposit. Fair value of the deposit is what? 10 lakhs is the future value. Present value is 10 lakhs into 567,427. So 567,427 is the present value of deposit. So today the present value is 567,427. Okay. The extra amount that we have paid will be considered as rent paid in advance and added to right of use asset. So value of deposit will be initially recognized at 567,427. There is no confusion there, straightforward. Prepaid lease payment, it's not prepaid lease payment, actually now it will be added to right of use asset. Difference between the two, 432,573. See, very simple and straightforward. 437,526. Okay. Now when you have long case studies, no, see, very long case studies, now see what is there. What amount contingent liability should be in relation to customer claim be recognized? Contingent liability after making adjustment for measurement period, and contingent liability based on previous valuation. Now what is this measurement period? We have a period of 1 year or 12 months, you can say, that if we have recognized something on a provisional basis, we will recompute the fair values etc. on the date of acquisition. Now here what we will also ensure is subsequent changes or subsequent developments we will not consider. Okay, we will only consider what was the condition on the date of acquisition, and within a period of 1 year we will do the changes. ABC acquires XYZ, first is an introduction, you can ignore it. They had certain amounts were due under penalty clauses for completion delays. ABC evaluates the disputes based on the information available on the date of acquisition and was responsible for at least some of the delays, and they recognize 1 crore towards the liability. This is fair value. Okay. Then on 1st of October, within the measurement period, customer presents the additional information as per which ABC Limited concludes the fair value of liability on the date of acquisition. On the date of acquisition is 2 crores. ABC continues to receive and evaluate information, the claim after October 1, its evaluation does not change until February 2. When did we acquire? 15th of January. So till February 2 there is no change. After 15th or 14th of January of year 2, right? After that point of time, any changes in the contingent liability will not impact the acquisition date accounting. When it concludes that the fair value of the liability for the claim on the date of acquisition is 1.9, this will not change. ABC determines that amount would be recognized with respect to the claim under Ind AS 37 as at February is 2.2 crores. Analyze and report. At what amount should be recognized initially? 1 crore. Okay. At what amount would be valued after making adjustment for measurement period changes on, and what account the adjustment is to be made with the difference in the value of previous valuation. Now here they have not told how to value NCI. They have not told NCI fair valuation. Okay, so we will assume, and they have also not told what is the percentage. So we will assume everything we have only acquired. So now what is the amount of adjustment? Oh sorry, what amount the contingent liability should be valued? During the measurement period, any changes, and the change has become what? 2 crores. So now the contingent liability will be 2 crores. So this is no longer, see, the first itself is 2 crores. So you know you don't need to make any changes there. At what amount will it be valued in the consolidated balance sheet on 31st March, and in what account the adjustment will be made for the difference in the valuation? So 2 crores of the previous valuation. After that, now the valuation as per closing balance is 2.2 crores. Okay, so now we will value it at what? 2.2 crores only. Sir, but in February there was a different number. We are looking at year end. Now, any difference 2.2 versus 2 will be debited to P&L. Okay, they have said return earnings debited to P&L by 0.2 crores. Okay, simple question but highly conceptual. Okay, simple but highly conceptual. If you know the concepts, you will be able to solve it immediately. Next one, again a long case study. What is the length of operating cycle? What would be the classification of trade receivable? And which of the following statement is correct with respect to entering into subcontract with F Limited? Okay, so first, A Limited is engaged in multi-production construction service center. So again, introduction, you can skip unless you cannot find the answer in the remaining part of the question. A Limited produces aircrafts. Length of time between the first purchasing raw material to make the aircrafts and date of the company completes the production and delivery is 9 months, receives the payment after 7 months. 9 plus 7 is 16 months. Okay. So 9 plus 7 is 16 months. What is the first question? Operating cycle 16 months. Okay. Classification of trade receivable, current asset, simple and straightforward. Right. Then A Limited provides advertising services to its customer. A Limited enters into subcontract with a multinational online video sharing company, let us say YouTube. F Limited under the subcontract, F Limited places all of A Limited's customers advert. Okay. So A Limited is providing services to its customer. So I am, let us say A Limited, I have my customers. I have entered into a contract with YouTube, and YouTube will place all of my customers ad. Okay. A Limited notes the following. A Limited works directly with the customers to understand the requirement. So I talk to my customers. A Limited is responsible for ensuring that the advert meets the customer need. So I am again responsible for customer need. A Limited directs F Limited over which advert to place and when to place. I will tell YouTube when you have to give my ad. A Limited does not bear any inventory risk because there is no minimum purchase requirement. So if there is no minimum purchase requirement, there is no inventory risk. Now this inventory risk topic is given to confuse you, because we would have learnt in the theory questions that if the inventory risk is not borne, then it will be an agent. But here there is no inventory risk at all, there is no inventory requirement. A Limited does not have discretion in setting the price because fees are charged based on F Limited schedule rate. Again, the rates are already fixed. Now the question is, which of the following statement is correct with respect to entering into a subcontract with F Limited? Now, when we are entering into a contract with F Limited, is A Limited acting like a principal or an agency? Customer is my responsibility. Providing service to the customer is my responsibility. The rates are fixed, that is a different thing. Other than that, F Limited does not have any other control, there is no inventory. So, it is not an agent, it is a principal. 16 months, current months and principal under the contract. Did they say receivable? They only said receivable, no? In the answer they have said inventory and debtors. They would have copied from somewhere else. Next case scenario, again there are two smaller cases. One is a very simple case, and then they have asked value of property to be reclassified, net realizable value of property, value to be shown in the balance sheet. This has come in a past exam. Okay, stage which of the following statement is correct, and which of the following statement of A and B is correct. Okay, so there are two parts, let us see. We need to know valuation on 30th September, 31st March. On 1st of April, X Limited purchased a large property consisting of land for 2 crores and immediately began to lease the property to Y Limited. So objective was to lease, so it will be what? Investment property. On an operating lease, annual rentals were 20 lakhs. On 31st March of year 5, the fair value of the property was 2 crores 60 lakhs. Under the terms of the lease, Y Limited was able to cancel the lease by giving 6 months notice in writing. When 31st March they gave a notice, so till 30th of September they have, they can vacate. Y Limited gave this notice on 31st March of year 5 and vacated the property on 30th September of year 5. Okay. On 30th September, fair value of the property was 2 crores 90 lakhs. On 1st October, immediately began to convert the property into 10 separate flats of equal size, and they intend to sell in the ordinary course of business. So investment property has now become inventory. X Limited spent a total of 60 lakhs on this conversion project between September and March. So these are our additional cost, 60 lakhs. The project was incomplete on 31st March, and the directors of X Limited estimate that they need to spend a further of 40 lakhs. This is cost to complete, and after which the flat could be sold for 50 lakhs each. So 50 lakhs into how many flats? 10. 500 lakhs minus 40 is the cost of completion. So this will be what? 460. Okay. Now, first thing, as per Ind AS 40, there is no fair value concept. When you reclassify from inventory to investment property to PPE, reclassification is done at carrying amount. Here they have purchased land, and because they have purchased land, it is not depreciated. So what is the carrying amount? 2 crores. What is the first question? What value should be property be reclassified on 30th September? 2 crores only. Okay. Then what is the net realizable value of the property? We already computed 460. 460. At what value will be the flat shown in the balance sheet as at 31st March? Now we have to see the cost. What is the cost? Cost is 2 crores plus they have incurred a cost of how much? 60 lakhs. So 200 plus 60, they will show it at 260. Don't take fair value. Don't get confused between that, conversion of stock in trade and all of that. It is done at carrying amount only. Alright. Then Mr. A is a domestic partner of Mrs. B, so they are both are related. Mr. A has investment in X Limited and Mrs. B has investment in Z Limited. Okay. Now what is the question? State which of the following statement is correct with respect to Mr. A's investment in X Limited. Now the question does not tell you whether there is control, significant influence and all of that, but yes, we know Mr. A and Miss B, these are members or close family members. Okay. If A controls, then B becomes relative, or if A has influence, B becomes related party, not relative, sorry. Mr. A is not a related party to X Limited even if it controls X Limited. Absolutely wrong, that is a straightforward question. Z Limited is related to X Limited. So, one more thing I forgot to tell you, in this kind of question, just make a chart. A is domestic partner, so A and B are domestic partners. A has investment in X Limited, B has investment in Z Limited. Control and all they have not given. Now, what they are asking here? So, A, B, X, Z. Yeah, A, B, X, Z. Z is related to X, we are saying these two are related. If Mr. A controls or jointly controls X, even if B does not control or jointly control Z. So, A controls X, but does B control Z? B does not control Z, correct? No. So, here also that related party will not happen. Z is related to X, Mr. A controls X and B controls Z. So, if two members of the same family or the close family member, if they control two separate entities, both the entities are related. Okay. So, this is the correct answer. State which of the following statement is correct if Mr. A and Mrs. B only have significant influence over respective X Limited and Z Limited. So, they have only what? Significant influence. A is related to X, B is related to Z, but X and Z will not be related. One of them have to have control to consider the other party to be related. So, X Limited and Z Limited are related party? No. They are not related party? Yes. A is related to Z? No. B is related to X? No. Okay. Next case, Z Limited is currently engaged in different business segments and is also looking to expand. So, again introduction not required. Z Limited has made an interest-free security deposit against a lease of 5 years. Same thing we discussed just now, so you can do it on your own. Z Limited, so this I will not do. Okay. Z Limited acquired 25% of the equity share capital of R Limited on the first day of the financial year for 1,25,000. As of that date, carrying value of the net asset of R Limited was 3 lakhs, fair value was 4 lakhs. Excess of fair value over the carrying value was attributable to one of the buildings owned by R Limited having a remaining useful life of 20 years. R Limited earned a profit of 40,000 and OCI of 10,000, and you have to give the answer. Now, 25% of equity share capital. So, fair value of net asset. What is the fair value of net asset? 4 lakhs. Our share is how much? Immediately, directly you can start the calculation. Our share is 25%. So, our share is 1 lakh. How much did we pay? We paid 1,25,000. 25,000 extra. So, 1,25,000 whatever is paid, goodwill is how much? 25,000. Will we recognize this goodwill? No. This is the first step. Carrying amount of investment will be shown at 1,25,000 only. Then, the difference of 1 lakh was because of a building and remaining useful life of 20 years. So, whatever is the difference 1 lakh into 25% divided by 20. So, 1 lakh divided by 25,000 into 25%. 1250 will be the adjustment for depreciation because of excess valuation. Profit is 40,000 and comprehensive income is 10,000. So, 40,000 का 25% we will add 10,000 and 10,000 का 25% we will add 2,500 and we will reduce 1250. Okay. So, what is the carrying amount? 1,25,000 plus 12,500 minus 1250. Carrying amount is 136,250. Why did I do it together? Because generally associate question will have all of this requirement, right? Prepaid lease, you can do it. Oh, so here interest income on security deposit. So, whatever is the security deposit amount, right? 567,427 into 12% is the interest income, and on which date? See, again they have not told the date. So, a lot of time in examination of which is the date of acquisition, we do not know. They just said first date of the financial year. So, we will assume April to March, and in the examination please be mindful to check these dates. Sometimes they may ask for year 3 also. So, 68091 is what I got into 12%. This is the interest income. Goodwill or capital reserve, we already computed 25,000. Z Limited share in profit and other comprehensive income, whatever is Z Limited's thing, 8,750 and what did we calculate? 10,000 and 2,500, 10,000 minus 1250. So, it has to be 10,000 minus 1250. So, why minus 1250? From the share of profit, that excess depreciation we have to reduce. So, that is 8750 and 1250. What will be the closing balance of investment? Closing balance of 136,250. 136,250. 136,250. Okay. Okay. So, next one, ABC Limited manufactures and sells healthcare product and food and grocery products. What are the questions? Operating cycle, classification, operating segments, which is not correct. Okay. So, again multiple conceptual question. 3 products A, B and C are manufactured. Product A is classified as healthcare product, B and C are classified as food and grocery products, B and C are similar product. Discrete financial information is available for each manufacturing location for the and for the selling activity of each product. There are 2 line managers responsible for manufacturing activities of A, B and C. X manages A, B manages C and B and C. Operating results and food and grocery products are regularly reviewed. Now, as far as for operating segments, when we see, we have to see for which segments do we have the discrete financial information and which are reviewed by the chief operating decision maker to make decisions, and they evaluate and all of that, right. So, here it is very clearly B and C are together similar product and A. So, what are the segments they have? How many segment? They have 2 operating segment, healthcare and food and grocery segment. I think that is a straightforward one. Okay, so this is a 2 operating segment. Then ABC provides the following information: raw material stock holding period 3, work in progress 1, finished goods 5, debtors collection. So, 3 plus 1 4, 14 months, trade payable 12.5 months, current liability. Okay. ABC owns 30% share capital of XYZ and has the ability to exercise significant influence. XYZ holds the following investments: 70% of share capital of the subsidiary PQR, 30% of share capital LMN with the ability to exercise significant influence. ABC Limited transactions with PQR and LMN Limited. So, you have ABC. ABC has significant influence over XYZ. XYZ controls PQR. XYZ also has 30% significant influence over LMN. ABC has transactions with, not XYZ, sorry. ABC transacts with PQR and ABC transacts with LMN. Okay. Now, let us see the question. State which of the following statement is not correct. They may not highlight and give it to you in the exam. Okay. So, I have to read it carefully. As per Ind AS 24 with respect to ABC, PQR and LMN. Now, tell me one thing. ABC has influence over XYZ. XYZ controls PQR. Can I say ABC also has influence over PQR? Because if I am influencing someone, that person is controlling something else, of course I have an influence. But here influence and influence will not give me influence over LMN. Okay. ABC Limited should disclose with PQR Limited in its separate financial statement. PQR is a related party of ABC because PQR is subsidiary of ABC associate XYZ. So, should ABC relate transactions with PQR? I said significant influence and control. ABC also is a related party here and is not a related party here. So, is the first statement correct? Yes, it is correct. So, this is not the correct answer. ABC is not required to disclose its transaction with LMN in the financial statement because LMN is not a related party. LMN is not a related party. LMN is not a related party. We have already seen. So, this is also correct. PQR is required to disclose its transaction with ABC Limited in its financial statement because ABC is a related party, but LMN is not required to disclose a transaction with ABC because they are not related. So, PQR with ABC related, LMN not related. Okay. ABC should not disclose its transaction with PQR. So, that itself is a false statement and hence option D is the correct answer. Next. So, it is a small case, so we will read the case and see. B Limited is engaged in many businesses. Introduction you can ignore. First, a gymnasium enters into a contract with a new member to provide access to its gym for a 12-month period at 4,500 per month. Member can cancel his or her membership without penalty after 3 months. So, till 3 months you cannot cancel, after 3 months you can cancel. Following information is given. This is a very standard question. Full capacity 10,000, normal 7,500, actual labor hours 6,500, total fixed overhead, production overhead, opening inventory 2,500, unit 6,500, sold 6,700, cost are done on FIFO basis. Okay. What is the contract term? 3 months, because after that you can cancel. Amount of fixed overhead allocated to unit produced during the year would be how much? Okay. So, normal capacity is 7,500 and fixed production overhead is 1,500. The question is on what? Fixed production overhead. So, 1,500 divided by 7,500, because you do not have machine hour, we will use labor hour, multiplied by how many hours? 6,500. How much do you get? 1,300. This is from a question in the material itself, 1,300. What is the total fixed and variable production overhead recognized as a part of cost of closing inventory of the year? Fixed and variable recognized as part of closing inventory. Okay. So, how much is there in closing inventory? Total opening inventory is 2,500, produced is 6,500, sold is 6,700. So, inventory, can I say 2,300 closing inventory, correct? Now, in that 2,300, what is the overhead to be charged into, what did they say? Total fixed and variable production overhead. Okay. So, 1,500 divided by 7,500 is 0.2. Okay. So, this is this mistake. So, we have 2,300 into 0.2. We have 460 of fixed. We have 460 of fixed. And variable is how much? Variable production overhead is 2,600 for 6,500. So, 2,600 divided by 6,500 into 2,300, 920. So, 460 plus 920, we get how much? 1,380. 1,380. I hope it is right. Option 1,380. What amount will be recognized as an expense in the P&L account? Now, there is a long way to do and also there is a shortcut way to do. So, what is the shortcut way? Shortcut way is, see, 1,380 will be a part of your inventory, correct? What is the total overhead? Total overhead, if you see, 1,500 plus 2,600, that is 26 plus 15 is 41, 4,100. So, total overhead is 4,100. Out of 4,100, 1,380 goes to closing inventory. So, here 4,100 minus 1,380, if you do, you get 2,720. 2,720 is the correct answer. 2,720. 2,720. Now, here one thing that I want to inform you or tell you is, if it was a normal question, what is there in the study material, we would have done this detailed calculation. Okay. And then we have said, okay, this is the expense and all of that, and accordingly we will say this much is to be charged. There is a detailed working. But for MCQ, once I know 1,380 is going to inventory, I can conclude that 2,720 is going to P&L. So, these kind of shortcuts will actually save you time in the examination. Okay, and don't do mistakes like what I have done here. That should not be the case. See, so much of detailed working they have given. Very, very detailed working, that is not required. That is what I am trying to say, that you can save time in the examination. Z Limited is a multinational company and prepares and presents its financial statements following Indian accounting standard. They make a sale of goods on credit for 45 days. Customers are entitled to earn a cash discount of 2% if the payment is made before 45 days, and interest at 10% is charged for payment after 45 days. Okay. Z Limited makes sales goods to customer on credit. Goods are carried in large containers for delivery to the dealer's destination. All dealers are required to deposit a fixed amount of 10,000 as security, which is returned when the contract with the company terminates. The deposit carries 8% per annum, which is payable only when the contract terminates. If the contractors are returned by dealers in broken condition, then adjustment shall be made. Okay. Z has following three types of interest in an associate: equity shares, preference shares, non-cumulative preference shares that form part of net investment in the associate. They are measured at fair value. Long-term loan carrying an interest of 10%, interest income is received at the end of each year. Long-term loan is accounted as per amortized cost. This also forms part of net investment. The carrying value of the above interest is given below. And the following table summarizes the fair value of preference shares, impairment loss on long-term loan, and entity share of profit and loss in year 1. So, this if you remember, there is this very long question in the study material where they talk about movement in your losses and movement in actually your investment values and how you should do the accounting. Throughout year 1 to 5, there have been no objective evidence of impairment in the net investment. Entity does not have any legal or constructive obligation to share the losses of associate beyond its interest. Based on the above, determine the closing balance of each of the above interest at the end of the year. So, see, this is from the question and then this is the MCQ part. Okay. So, what do we understand? Basically, MCQs are also being taken up from the questions in the study material, just that we have to be smart enough to work our way around. Okay, how do we reduce the steps? How do we work out in the rough note and get to the answer correctly? Sometimes just basis the calculator we can do it. So, that should be the idea of your MCQ practice. The session here today is not to explain you concepts again. All of you are aware of the concept. How can you save small time in the examination? That will actually help you to save time for descriptive papers. All right. Now, what will be the classification of trade receivable in the books of Z Limited? So, they gave a lot of GAN here. What did they say? They are entitled to earn a cash discount 2%, customers on credit 45 days, and if the payment is made after 45 days, interest is charged. Current or non-current? Trade receivable, it is a current asset within 12 months. Sir, but they can pay after 45 days? Yes, but the contractual right or the right to receive cash is within 45 days. So, it is a current asset. Which current asset? Non-current, non-financial, non-current financial, current financial, current non-financial. So, it is current financial asset. What will be the classification of deposit in the books of the dealer? Now, what is the deposit? See, the deposit they are saying, which is returned when the contract is terminated, and when the contract gets terminated and they do not have any specified period. So, generally these contracts are for longer periods. Okay, that is what we can assume. Typically, and they are also saying deposit carry interest and payable when the contract terminates. We can assume that these are longer term contracts, and more appropriate thing would be it is a non-current. Now, deposit in the books of the dealer, not in the entity. It is not in the books of Z Limited, it is in the book of the dealers. Okay. So, dealer have a right to receive what? They have a right to receive cash. So, it is a financial asset. An appropriate classification would be non-current financial asset. The closing balance of equity share interest in the associate at the end of year 1 will be how much? So, here if you see what is the cost, the equity share and all of that, carrying value is 10 lakhs, 5 lakhs, 3 lakhs, total carrying value is 18 lakhs. Okay. Then share of loss is what? 16 lakhs. And impairment loss on long term loan is 50,000, decrease in fair value preference share is 50,000. So, 50,000 is the preference share impairment and long term loan also 50,000, and there is a share of loss of 16 lakhs. Now, if there is a share of loss of 16 lakhs, what will be the value of equity share interest? The equity share interest will have to be 0, correct? Why 0? Because entire equity balance will be written off because there is a loss. Now, please understand, if 16 lakh is the share of the loss, likelihood that preference shares and long term loan may also not get anything. So, out of 10 lakh is fully written off. After 10 lakhs is fully written off, we are left with how much? 6 lakhs. The closing balance of preference share interest in the associate at the end of year 1 will be how much? Now, preference share, there is a loss of 50,000. So 5 lakhs minus 50,000, this is also will become 4,50,000. This fully we will be writing it off. So out of 16 lakhs of loss, 10 lakhs will be written off against equity first, then another 4,50,000 will be written off against preference shares. Impairment 50, 450 gone. So we are left with how much? 0. So this balance will also be 0. Then what will be the value of long-term loan? Now long-term loan, if we see how much do we have, 3 lakhs minus 50,000 is the loss, balance is 2,50,000. Here 10 lakhs is gone, 450 is gone, here we are left with 1,50,000. So 250, 150 means 150 will write off, the loan value will be 1 lakh only. Okay, again repeated question from the material I would say, and we will be able to solve this, that should not be a challenge. So multiple aspects. So this is related to which activity of advance tax should be classified in the statement of cash flows, fixed asset in the cash flow, revaluation of trademark. Okay, so this is more to do with the cash flow aspects. X Limited is engaged in many businesses for which it is in the process of acquiring fixed asset and intangible asset. They prepare financial statement in Ind AS and follow April to March. They paid an advance tax of 530 during the current year. Out of the said tax, 30,000 is for long-term capital gains. Now here what is the question? Under which activity advance tax should be classified? Now advance tax, how much did I pay? 5,30,000. Now 5,30,000 if that is paid, out of that 30,000 they are saying is towards capital gains. Capital gains means investment activity. So 30,000 should be shown under investing activity, not operating activity. So this is the correct answer. Next. X acquires fixed asset of 10 lakhs from Y Limited by accepting the liabilities of 8 lakh and balance amount will be paid in cash. So net amount of cash, how much did we pay? 2 lakhs. So X should classify cash payment of 2 lakhs under investing activity and remaining 8 lakh being non-cash transaction should be disclosed in the notes to financial statement. This is the correct answer. Cash payment of 10 lakhs, no. Remaining 8 lakhs should be disclosed in notes to financial statement. Operating, 2 lakhs operating is no. 2 lakhs should be shown as cash and cash equivalent, no. Then X Limited acquired a trademark on 31st March for 1 lakh. The asset was revalued at 1,20,000 on 31st March and 85,000 on 31st March of year 3. What is the treatment of revaluation of trademark on 31st March of year 3? Ignore computation of amortization on it. 35,000 of the revaluation decrease in 31st March should be debited to revaluation reserve. So first we have to see. 1 lakh became 1,20,000. So 20,000 goes to what? OCI. Are we clear? Then 120 became 85. 120 minus 85, it is 35. Correct? 120 became 85 means 35 loss. Out of 35, 20 will be debited to OCI and 15 will be debited to P&L. So 35 should be debited to revaluation reserve, no. 35 should be debited to P&L, no. 20 should be debited to revaluation and 15 should be recognized in expense is the correct answer. No adjustment, wrong. X Limited acquired patent on 31st March for 1 lakh. The asset was revalued at 85,000 on 31st March and 1,05,000 on 31st March of year 3. So 15,000 goes to P&L, 1 lakh to 85. Then 85 to 1 lakh is 20,000 gain. 15,000 credited to P&L, 5,000 goes to other comprehensive income. 5,000 should be recognized as income in P&L, no. 15,000 should be recognized as income in P&L and remaining revaluation reserve, correct. X Limited enters into a 10-year contract with A Limited for use of rolling stock specifically designed for X Limited. Rolling stock is designed to transport materials in X Limited production process and is not suitable for other customer. This is not explicitly specified in the contract, but they have only one rolling stock for use. If rolling stock does not operate properly, contract requires it to replace. This is a contract of lease. It is identified because they have only one and repairs and maintenance breakdown related replacement are considered. So for 5, rolling stock is an identified asset. Yes, that is the correct answer. Okay. Next, long case study. So let us see what is the question. How many performance obligation, unused vacation in this 19, what amount they should make provision, and what should be the accounting treatment of processing fee, and what should be the accounting treatment of processing fee in case future drawdown is not proper. Okay. So 5 different items. PQR is engaged in providing a wide range of telecommunication services, mobile connectivity, broadband, enterprise network. It prepares its financial statement in accordance with Ind AS and follows the financial. See again, this basic introduction you can ignore, right? Because that is just a time waster for us. Customer buys modem for PQR from PQR. Modem, I don't know who uses currently. Customer can also get the connection from PQR Limited and modem from any other vendor. So you can get connection. Modem can be purchased from outside also. The installation activity requires limited effort and the cost involved is almost insignificant. It has various plans where it provides either broadband services or voice call services or both. So modem you can purchase from anybody else. There is no significant modification involved. Cost involved is also insignificant, right? That's the first part of the question. How many performance obligations are there? So modem, see, modem is not bundled with the internet services. I can buy modem separately. I can buy modem, or if you don't understand modem, think of it as a router. I can buy router separately from outside and I can take only broadband service, or I can take broadband service as well as the router. So I have how many performance obligation, or the supplier has how many performance obligation? 2 performance obligations there, and you have voice call. So all 4 are performance obligations, separate performance obligation. What should be the total unused vacation? Let us look at the second part. PQR has 350 employees, same as year ago. Average staff attrition rates observed during the past 10 years represent 6% per annum. PQR Limited provides all employees paid vacation of 10% per year regardless of date of hiring. So whenever you hire, you give 10 days. Compensation for paid vacation is 100% of employee salary, and unused vacation can be carried forward for 1 year. As of 31st March, unused vacation carried forward was 3 days per employee. Average salary was 15,000 per day, and expense in the year 1 was 65 lakhs. During 1-2, employees took 9 days of vacation in average, and salary increase was 10%. Okay, so slightly confusing or complicated, I would say. They have 350 employees, 6% leave. So what would you say? 350 minus 6%, 329 employees leave. Correct? 329 employees leave. Now, what are they saying? The average staff attrition rate observed during the past 10 years 6%. PQR provides all employees paid vacation of 10 days per year regardless of date of hiring. So whichever date you have hired, you get how many days? 10 days per year. Compensation for paid vacation is 100% of employee salary, and you can carry forward for 1 year. Unused vacation carry forward was 3 days per employee when on 31st March of year 1. Average salary was 15,000 per day. Accrued expense for unused vacation was 65 lakh. In year 1 2, employees took 9 days of in average. Now what is the question about? Total unused vacation in terms of man days in as on 31st March of year 2. That is the question. Total unused vacation as on 31st March of year 2. We are having how many employees? We are having 350 employees. Now here, out of these 350 employees, 6% are new, and 350 minus 6%, 329 are old. 21 are new, 329 are old. Okay. For 21 employees, we will give them how much? 10 days of leave per year. 10 days of leave per year, and they will take 9 days of that they have taken. So 10 minus 9, how much is left? 1 is left. So to them we have 21 days of leave. For 329 employees, they have 3 days of carry forward, plus they will get 10 days. So they have 3 plus 10. This 3 is fully utilized and balance 6 is utilized here. So how much is left? 4 is left. So 329 into 4 is equal to 1316 plus 21 is 1337. Now 1316 is also there, 1337 is also there. We might get confused. Answer is 1337. I am repeating once again, 21 employees will have only 1 day in their account, and 329 will have 4 days in their account because of carry forward. What amount of should PQR make a provision for unused paid vacation for year 1, year 2? Now year 1, year 2 means how many employees are there? 1337 employees are there. Okay. Now what is the salary? They have said the salary is 15,000 per day. My God, 15,000 per day. And what is that? As on 31st March of year 1. So in a hurry, especially that was what when I was saying, right? When we have complex questions and if we don't have sufficient time, we may not be able to do it properly. So how many leaves are they saying? They are saying that the leaves are we calculate 1337, 15,000 day in year 1 per day, 10% will be increased. So now the average salary will be 15,000 plus 10%. 15,000 plus 10%. So 15,000 into 10%, 1500 plus is equal to 16,500 into what are the number of days? 1337. So we get 220,60500. Okay. But they have also said that an accrued expense of 65 lakhs was there. By what amount should PQR Limited make provision? So make provision should be 220,605. How much will go to P&L means then we will do minus 65 lakhs. Okay. So here they are asking closing balance. So 220 is the answer. Alright. Then next, PQR Limited has taken a 6-year term loan disbursed in different tranches from April year 0 to April 6. On the date of transition to Ind AS, it has calculated the NPV of the term loan disbursed up to 31st March of year 5 by using effective interest rate and proportionate processing fee has been adjusted in the disbursed amount while calculating the net present value. So they have taken from bank and paid processing fees at the time of sanction. Loan is disbursed in different tranches. Loan is deferred in different tranches means what? You'll take loan multiple times, but you have paid a single payment. Okay. Now here, what will be the accounting treatment for the processing fee belonging to the undisbursed loan amount in case future drawdown is probable? If you are believing that in future drawdown means taking the loan, if future drawdown is probable, then what we will do? The processing fee is accounted for a transaction cost under Ind AS 109 but not deferred from the carrying value of financial liabilities when the drawdown occurs. Now please understand, I have paid a lump sum, let us say 1 lakh of fees, and I have said in the next 5 years I will take loan, and whenever I take loan you adjust from the 1 lakh fee that I have paid. Okay. So here, can I defer? See, if the loan is happening in the future, how can I account for transaction cost now? That is related to future loan, and they have said it is probable. So this is not the correct answer. Processing fee is accounted for as a transaction cost under Ind AS 109, and the fee is deferred and deducted from the carrying value of financial liabilities when the drawdown occurred. That is the correct option. Processing fee is recognized as an expense on straight line basis? No. Processing fee is not accounted for as transaction cost under Ind AS 109, but is deferred and deducted from the carrying value of the financial liabilities when the drawdown occurred. So this also is wrong. Now why is it wrong? The only statement that makes it wrong is processing fee is accounted, not accounted. The remaining thing I have written same. Okay. What would be the accounting treatment of the processing fee belonging to undisbursed loan amount in case future drawdown is not probable? Okay. Now in case future drawdown is not probable, right? Future drawdown will not do. Now already we have taken some drawdowns, right? Once you have taken those drawdowns and we are saying that okay, let's say 50,000 of processing fee is still left over, but in future will not draw down. Will it impact the cost of my existing liabilities? No, because that is not the transaction cost of existing liability. So what will happen? Processing fee is accounted for transaction cost under Ind AS 109 but not deferred and deducted from the carrying value of the financial liabilities when the drawdown occurs. Now the drawdown is not happening, so this will not happen. Processing fee is accounted for as transaction cost and the fee is deferred and deducted from the carrying value when the drawdown occurs and considered in effective interest rate. There is no drawdown happening. Processing fee is not accounted for as transaction cost and recognized as an expense on SLM basis over the term of the loan. So over the period for which we are saying that okay, the loan tenure is there, over that period we will apportion the processing fee. Now the reason here is the processing fee, let's say I have taken a drawdown of 500 and 1000. There are two drawdowns that I have taken and I can take another 2000 in the future. If now after taking two drawdowns I realize that I will not take the drawdown further, the extra processing fee is not for 1500. So over a period of the loan, the loan tenure that subsides, I will be writing it off to P&L, because in future I may change my mind and again I may take the processing fee, I may take the loan. This we have done. Next, on consolidated financial statement. So what all they have asked? Net asset on the acquisition date, goodwill at fair value, goodwill in case they are measured at proportionate share in net asset. So this, I know all of you know how to solve this question. It is nothing that it's a new question or a new concept. All of you are champions in consolidated financial statements. Now what we have to do or what we need to ensure is how to quickly do this. That is the important objective. Conceptually you are 100% clear. I am for sure that all of you are clear. How to do it quickly, that is the trick you will be getting in this particular question. Okay. The next one, ABC Limited prepares consolidated financial statement on 1st of July. Now it becomes important. ABC Limited required 75% of the equity shares of JKL Limited and gain control. Issued shares of JKL is 1 crore 20 lakhs shares. Detail of purchase consideration are given below. On 1st July, ABC issued 2 shares for every 3 shares acquired in JKL Limited. On 1st July, market value of an equity share of ABC was 6.5, market value of JKL was 6. Now, mistakes that I have seen that student make is they will say 120, 2 by 3 they will calculate and then be done. Please remember, we are only 75%. So, 1 crore 20 lakhs or 120 lakhs into 75% is what we are acquiring, and we are giving 2 for 3. So, divided by 3 into 2 if I do, we are giving 60 lakhs equity shares. We are showing 60 lakhs equity share. The fair value of this consideration is 60 into, who is issuing? ABC. So, ABC is 6.5, 60 into 6.5, it is 390. This is the first part of the consideration, you note it down separately. And do not write like this, you will get confused later, 390. On 30th June, ABC will make a cash payment of 70,50,000 to the former shareholder of JKL. On 1st July, who have sold, on 1st July, ABC would have paid interest at the rate of 10%. So, 71,50,000 is what is paid, correct, divided by 1.1, the consideration is 65. On 30th June of year 3, one more year after that, ABC may make a cash payment, contingent consideration, to the former shareholders of JKL who sold their shares on 1st of July. Payment is contingent over revenues and all being increasing. On 1st July, the fair value of this contingent consideration is 2 crores 50 lakhs. So, fair value is 250. On 31st March, fair value is 220. This you will ignore. Sir, but it is within 1 year, but they have not said it is a provisional valuation. So, we will not do. So, we will take 250 only. 1st July, the carrying value of identifiable net asset in the books of the company is 600 lakhs or 6 crores, and the fair value is 7 crores. Rate of deferred tax to apply on temporary difference is 20%. Always remember, when there is a gain, there is a DTL. So, what is the fair value now? Fair value is 700. And because of this 100 into 20%, 20 will be the DTL. So, net fair value is 680. During 9 months ended 31st March, JKL had a poorer than expected operating performance. Therefore, on 31st March, it was necessary for ABC to recognize goodwill arising on acquisition of JKL amounting to 10% on computed value. So, whatever goodwill comes, 390 plus 65 plus 250, 705 is what we have paid. I hope it is correct. I have not missed out something. Okay, 10% is the impairment. So, let us see. Sir, why did you compute everything? See, just to tell you how you can quickly compute in a short time based on whatever you are reading. Okay. Now, what is the first question? What would be the amount of net asset on the acquisition date? Net asset on the acquisition date 680, 680. Why? Because there is a DTL. What will be the amount of goodwill in case NCI is measured at fair value? Oh, sorry. We have not yet considered NCI. Okay. So, for calculating goodwill, we need NCI. Now, what are they saying? NCI is measured at fair value. If NCI is measured at fair value, NCI will be 120 into 25% and the share value is 6. Do not get confused. Okay. We have to take JKL into 6. So, that is 180. So, 180 is NCI. 705 minus 680 is 25 plus 180 is 205. So, valuation is 205. What will be the amount of goodwill in case the non-controlling interest is measured at proportionate share of fair value of net asset? So, that you can directly do. So, here when it is proportionate share of net asset, do not do NCI as 25% and all of that. Simply what you do, take the net asset 680 into 75% minus 705, 195. So, answer is 195. Again, what I am saying, net asset into 75% minus purchase consideration is what you will do. Do not do NCI into 25%, it will waste your time. Okay. 680 we did, 205 and 105. Then impairment we will do at 10%. Now, just because we are discussing, if NCI is at fair value, then this will be split between parent and NCI. If this is at proportionate share of net asset, only the parent will bear the loss. One more thing you have to keep in mind. Next, Z Limited is engaged, again a long case. What will be the amount of provision for penalty for illegal use of automobiles? Calculate the amount which should be shown in other comprehensive income. What will be the finance cost of convertible loan notes issued by Z Limited? Z Limited is engaged in manufacturing of automobiles with its registered office in Pune and is listed in the Bombay Stock Exchange. It also owns a chain of retail stores across 20 different locations in the twin cities of Pune and Kolhapur. Introduction ignore. Following are the brief facts about the transaction entered into by the company, for which accounting advice is sought by the CFO of Z Limited from you. This also you can ignore. Z Limited owns 2 vehicles and a local statute was passed which necessitated Z Limited to undertake modification to the vehicles to enable reduction of emission of harmful emissions. The modification should have been completed by 31st December at an estimated cost of 20 lakhs. By 31st March, none of the vehicles had been modified, although they continue to be used. It is quite likely that Z Limited have to pay a penalty of 2 lakhs per month for illegal use of vehicles. The directors of Z Limited intend to carry out the modification only at the end of March of year 3 due to paucity of fund. They expect that the penalty will become payable very shortly as the legal action has been initiated against Z Limited. So that is the first part. Now what is the question? What will be the amount of provision for penalty for illegal use of automobiles Z Limited will have to make on 31st March? Now the doubt that you will have is, sir, should we take only the penalty amount or should we also take the expected modification cost? Now here if you see, modification is our choice. If you don't modify, we will pay the penalty. So what is the penalty amount? Penalty amount is 2 lakhs per month. We don't have any obligation that we have entered into a contract with someone or we are bound by contract to get it modified. We have not yet done that. We will pay penalty 2 lakhs per month. How many months? 31st December, 31st March, 3 months. 2 into 3, 6, and they have 2 vehicles. So what is the amount of thing? Penalty amount will be 12 lakhs. Okay, then calculate the amount that should be shown in other comprehensive income. Okay, the next part. On 1st April, Z Limited issued 1 lakh notes of rupees 5 each. The loan notes entitle the holder for an interest payment of 8% per annum payable annually in arrears. Loan notes are repayable at par on 31st December of year 5. As an alternative to repayment, holders can elect to convert the notes into equity shares. On A Limited, on 1st April, investor in non-convertible notes expect a rate of 10%. Okay, so 8%, 10%, 73, 68, 3 rates are given. When did they issue? 1 lakh notes of 5 each. Okay. On 1st April, Z had 2 equity investments. So equity investment is separate. So what is the question on that? What will be the finance cost of convertible loan notes issued by Z Limited for the period ending 31st March of year 2? Where are we? We are on 1st of April of year 1. 1st of April of year 1. 1 lakh loan notes. Interest is payable at 8%. Outside rate is 10%. Okay. Now what are the options? 1 lakh into 8% should be 8,000. Okay. So do we have any option closer to it? Finance cost of convertible notes, there is no option closer to this. So if there are no options closer to this, then we will do the calculation. Okay. So interest is 40,000. Okay. How do we get the interest? 1 lakh into 5 into 8%, 40,000 into 3.17. Principal repayment is 1 lakh into 5, which is 5 lakhs. So what is the present value? 5 lakhs into 0.6830. Okay. So that is 341,500. Then 3.17 into 40,000. This is 126,800. If I do grand total, I get 468300. Into 10%, 46830 is the answer. 46830 is the answer. So what I was trying to tell you as a part of approximation is, one thing that you can do is, because the value is 5 lakhs, will the option be 40,000? No, interest cost cannot be 40,000. Can it be 50,000? Again, there is a compound financial instrument component, so very unlikely that it will be higher. Okay. Then out of these two options, you can, if at all the options are very far apart, then you may choose one of the options. But here, because the options are close, you need to do the calculation. On 1st April, Z had 2 equity investment that it designated as fair value through other comprehensive income in accordance with Ind AS 109. Original cost, fair value. Okay, 3 are given. Fine. On 20th February, Z Limited disposed of its investment in K Limited. So this K Limited is sold on 20th February of year 2. and shown a profit of sale as a part of investment income. So, what has they classified? They have classified it as fair value through other comprehensive income. Apart from recording the receipt of dividend income, no other entries have been made in the financial statement for both the year ended 31st March regarding the investment in H Limited. Both investments had been correctly treated in the financial statement in year 1. They have two equity investment, fair value through other comprehensive income. Okay. Now, what is the question? What is the amount that should be shown in the other comprehensive income for the period ended 31st March on account of equity investment made by Z Limited? Okay. So, now what will be the fair value that you should show for which period? 31st of March of year 2. Now, when we come to 31st of March of year 2, what has happened? One is this change from 35,000, this value has increased to 38,500, correct? So, this is 3,500. Then amount to be shown in other comprehensive income. Now, is it the other comprehensive income in the P&L or in the balance sheet? They have not said. So, one is for sure 3,500 is there. Then what happens to the profit on sale of this investment? That profit on sale of that investment is recognized in P&L, and that 7,500 gets reclassified to your equity, okay, retained earnings, other equity. So, now 3,500 is current year OCI, 35 minus 27,500 minus 27,500, this is existing OCI balance of 7,500. Now, profit on disposal should be recognized in income statement. I think this is incorrect, that is what I believe. Okay. So, profit on disposal should not be in other comprehensive income. So, the answer here is incorrect, it has to be 3,500. See, fair value changes is recognized in other comprehensive income, that is understood, but the profit on disposal goes to P&L. So, I hope they update this question subsequently. Next one. State which of the following statement is correct with respect to bonds issued by C Limited on 31st March. What is the transaction price to sell the machinery to consumer? State which of the following statement is correct with respect to fraud, and what is the amount of deferred tax? So, 4 items are there. C Limited is preparing balance sheet, okay, date is 31st of March and the board will approve on 30th of May. 1st April, C issued 1 lakh 10 bonds for 10 lakhs. On 1st April of each year, interest at the rate of 8% per year is payable on outstanding capital amount of the bonds. First payment will be made on 1st of April of year 4 after 1 year, okay. On 1st April each year, C Limited has contractual obligation to redeem 10,000 of the bonds at 10 per bond. In its balance sheet, how should this be presented in the financial statements? So, what has happened? They have issued 1 lakh bonds, for how many years they have not said. What they have said is every year they have to redeem 10,000 of bonds at 10% at 10 rupees per bond, and they have also not mentioned about any contractual rate and all. So, what is the question? Which statement is correct with respect to the bonds? Now, we will assume that the coupon rate and the market rate is same, which means both is 8%, and if both are 8% and redemption value is also same, so both are 8%. So, what is the interest? 10 lakhs into 8%, 80,000 is your interest. So, how much will you show? You will show 80,000 as accrued interest. So, 80,000 is the accrued interest, okay. Then we have to pay how much? 10,000 into 10, 1 lakh has to be paid within 1 year. So, 1 lakh will be current, 1 lakh will be current and 9 lakhs will be non-current. So, 1 lakh is the current portion and 9 lakhs will be the non-current portion. So, option A is the correct answer. Second, what is the transaction price? C Limited sells a piece of machinery to the customer for 2 million payable in 90 days. C Limited is aware at contract inception that the customer might not pay the full contract price. C Limited estimates that the customer will pay at least 1.75 million, which is sufficient to cover C Limited cost of sales, that is 1.5 million, and which C Limited is willing to accept because it wants to grow its presence in the market. C Limited has granted similar price concession in comparable contracts. They conclude that highly probable they will collect 1.75 million and the amount is not constrained. So, what is the question? What will be the transaction price? 1.75, because that is the amount we are expecting to collect. On 15th of April, the company discovers a significant fraud that actually occurred during financial year 1-2. The fraud involved overstatement of revenue by manipulating sales invoices during those years. 15th of April, when is the board meeting? 30th of May. So, what we should do? Prior period error, rectify. The discovery of fraud is a non-adjusting event. Wrong. Discovery is an adjusting event as the fraud took place before the end of the reporting period, which has been confirmed after the end of the reporting period, but before the approval of the financial statement, hence to be adjusted in year 3, year 4 with retrospective. Correct answer. Simple, straightforward. Last one. C Limited recognized goodwill worth 80 lakhs in the past business combination. The current year it has impaired the goodwill by 16 lakhs and the carrying amount of goodwill is 64 lakhs. Amortization or impairment of goodwill is not deductible as per tax regulation in the jurisdiction in which C files the return. Applicable tax rate is 30%. Right. Now, whenever you recognize goodwill, initial recognition, you will not have any deferred tax asset or liability. So, amount of deferred tax or asset or liability will be nil. Okay. Now, what will these case scenarios discussion help you at? First is it will help you to quickly revise the concepts. Second is some small tips and tricks that you will get as we solve these MCQs, so that you save time in the examination and arrive at the answers quickly. So, that is the second objective. Definitely that is what we want to do. So, let us start like we did yesterday, quickly reading the requirement of the questions and followed by discussion of the case and arriving at the answer. So, when it is a small case, you can read the case first, but here again it is a lengthier case. So, calculate the depreciation charge for year 3 in accordance with Ind AS 16, calculate depreciation charge for year 4 in accordance with Ind AS 16, at what value license would be recognized by ABC as a part of business combination, and gain or loss on settlement of the license contract, and what will be the amount of PC to be considered for PQR and added to the numerator for calculating diluted earnings per share. So, multiple standards are tested here. Let us look at the answer. So, here you can clearly see one is PPE. So, once you are done with studying or reading the PPE part, we can get into the solution. ABC Limited acquired an asset 3 years ago at a cost of 5 million. 5 million is 50 lakhs. The depreciation method adopted was 10% reducing balance method. Now, here is where I will tell you how to quickly arrive at the closing balance of PPE without doing detailed calculations. Okay. At the end of year 3, ABC estimates that the remaining useful life of the asset is 8 years and determines to adopt straight line method from that date so as to reflect the revised estimated pattern of recovery of economic benefits. So, here what has happened? Here what they are saying is, first they followed WDV, then they are moving to SLM method, right. Now, no need to do step by step in detail. What you can do is directly take your calculator. Depreciation is what? 10%, right. Now, what is the question? In both the questions we have been asked depreciation charge for year 3 and year 4. So, how to calculate quickly? 50 lakhs is there, right, and what is the depreciation for first year? 10%, that is 5 lakhs. So, year 1 is 5 lakhs. Okay. Now, the question is what is the depreciation charge for year 3, right. Now, when we say year 3, how to calculate? First year depreciation is year 5, you can see it on the screen here, alright. Now, what you do is into 0.9, because depreciation is 10%, every year depreciation will reduce by 10%, so it will be 90% of previous period depreciation. Nobody will tell you this, tell you this in the class. So, 0.9 if you do, you get 4.5 and is equal to 4.5 into 0.9 if you do, you get 4.05. So, answer is 4.05. How did we do? 50 into 10%, this is year 1 depreciation into 90% into 90%, and if you are quick enough with calculations, you can do 5 into 81%, you will get 4.05. Saves time. That is what we are looking at when we discuss this MCQs. Then one doubt you will get is, sir, but they have said that at the end of year 3 they estimated the remaining useful life. So, here the assumption is year 3 till year 3 we are assuming WTV. After year 3 has been concluded, now we are switching to SLM method. Okay. Now, they have revised the useful life to 8 years and to adopt SLM method from that date. Now, how to quickly calculate? We need WDV at end of year 3, correct. So, WDV will be 50 lakhs into 90% to the power of 3, 90%, 90%, 90%. So, 50 into 0.9 is equal to, or 0.9 into 50 is equal to 1, 2, 3. We get 36.45. Alright, divided by 8 if I do, I get 455,625. This divided by 8, 455,625. See how quickly we can calculate. Now, if you see the solution what they have given, detailed calculation. See, Do you need to do so much of detailed calculation? You don't need to do so much of detailed calculation. Directly you can do the way I told you. Again, I am recapping the shortcut for you. If it is WDV method, depreciation of year 1 into 90% will give you year 2 into 90% will give you year 3. Alright. Then next part of the question. Later, ABC acquires PQR for a consideration of 1 crore. 4 years ago, ABC had granted a 10-year license allowing PQR Limited to operate in Europe. The cost of license was 2,50,000. The contract allows either party to terminate the franchise at a cost of the unexpired initial fee plus 20%. Okay, so 250 is for how many years? 10 years. 4 years back. So how many years are left? 6 years is left. So 250, 25,000 into 6 is 1,50,000 plus 20% you will get at 1,80,000. Okay. Now, if you recollect, the same question is there in the study material where the consideration is also 1 crore and we have to recognize it at the settlement part of 1.8 and the difference I think 97.2 or 98.2 is accounted as purchase consideration. Okay. If you recollect, now it is not necessary that you will recollect the same in the examination, but still we will discuss that, right. ABC Limited has acquired PQR because it sees high potential in European market. ABC calculates under current economic condition and at current prices, it will grant 6-year franchisee for a price of 4,50,000. Now, this is the current valuation. Now, when you reacquire an existing right that you have given or maybe you can say a settlement of an existing relationship, the intangible asset will be recognized at 4,50,000 fair value. The reacquired right, the part of the consideration that we have paid, out of that, how much is attributable to settlement of existing relationship, that will be lower of the two, that is 450 and here you can see settlement penalty 180. So, coming to the case scenario, at what value should the license be recognized in the business combination? It is done at fair value 4,50,000. Gain or loss on settlement of the particular license is 1,80,000, which represents the penalty lower of the two you have to take. And what amount of purchase consideration should be considered? 1 crore minus 1.8. See, I am not discussing this in detail, the concept. The concept we have covered in detail in the classes as well as in the revision lectures. You can have a look at it. So, here what happens is out of 1 crore that you have paid, 1.8 is towards settlement. So, this settlement amount is not a part of your purchase consideration. What is part of your purchase consideration? Minus 1.8. So, you get 98.2. Now, think of it, if same question comes in the exam, study material, same thing put here, same thing if it comes in the examination, just by looking at the question you can get the answer, alright. Then, what amount should be added to the numerator for calculating diluted EPS? So, third part, the accountant of ABC has following information in his possession for the purpose of EPS and diluted for the financial year 1-2, net profit 12 lakhs attributable to ordinary shareholders. Weighted average number of equity shares 1,50,000, 6% convertible debentures 1,000, 10 lakhs each, convertible into 20 shares, dividend arrears, cumulative preference shareholders 10 lakhs. Now, dividend whatever you pay in arrears, okay, cumulative. Now, arrears, if it is for current year you will reduce, if it is for past year you will not reduce. Tax rate is 25%. Okay, so this is the thing. Now, what is the question? What should be the amount added to numerator for calculating diluted EPS? Now, diluted EPS will be for convertible debentures only. Now, what is the convertible debentures interest? 10 lakhs into 6% we pay. Now, they have not given effective rate, otherwise we will take the effective rate. Here nothing is given, so we will take the coupon rate, 60,000. So, options you see are 60,000. So, here again, and this can happen in real life also, okay. They have written amount as 1,000. How do we understand this 1,000 as the amount? And they are saying 6% convertible debentures of rupees 10 lakhs each, and now they are saying amount is 1,000. Now, what do we understand this as amount? So, what we need to do is we need to make reasonable assumption. Okay, 60,000 is the interest, 6% into 10 lakhs. Now, here we have 25% tax rate. So, whenever we add back debenture interest for convertible cases for the purpose of calculation of diluted EPS, we will take after tax. After tax means into 75%, we get 45,000. So, let us see what is the option here. So, we have 4 options. So, 45,000 is the number to be added to the numerator for calculating DEPS. Now, again, I hope they bring out the clarity that this is maybe, when they are saying 10 lakhs each, maybe debentures of 100 or debentures of 1000, and 1000 is the number. That could be the scenario. We have to take suitable assumption and then we have to do it. Okay, 45,000 is what they have taken, but the information given in the question is inconsistent and they have not given the solution also. Okay, fine. Next one, again a long case. Lease term. Okay, lease liability recognized initially. At what value should right of use asset be recognized initially? Depreciation and deferred tax to be calculated for the year ended rate. Okay, so 3 options are there. First, X Limited prepares, okay, on Ind AS. So this is not relevant. X enters into an agreement with Y Limited to lease an entire floor of a building for a period of 10 years with an option to extend the lease for 5 years. X is not reasonably certain to exercise the option to extend the lease. So first was what? Lease term. Lease term is 10 years. Okay, so it's such a straightforward question. At the commencement, lease payments are 50,000 per year during the initial term and 55,000 during the option. So this is not relevant now. As per the terms of contract, lease payments are required to be paid at the beginning of each year. To obtain the lease, X Limited incurred initial direct cost of 20,000, out of which 15,000 relates to payment to a former tenant for occupying that floor of the building and 5,000 relates to a commission paid to a real estate agent that arranged the lease. These are initial direct cost. As an incentive to X Limited for entering into the lease, Y Limited reimburses X Limited the real estate commission of 5,000. Okay, so this 5,000 is reimbursed, so this will get knocked off. The interest rate is not readily determinable. Incremental borrowing rate is 10%. Now always remember, first priority is what? Interest rate implicit in the lease. That is our first priority. If that is not there, what will we take? We will take incremental borrowing rate for discounting. What do we need to discount? 50,000 per year. Okay, now deferred tax asset is a separate thing. So we will come back to it later. What would be the lease term? Lease term is 10 years. There is no doubt about it. Then at what value is the lease liability recognized initially? Now here, if you ask me, the way they have drafted this question, here they have not told clearly whether the 50,000 is paid before the commencement. What they have just said, they have said to be paid at the beginning of each year. So here lease payment is 50,000. Term is 10 years. It is beginning. Now, if for 10 years we are paying at beginning of each period, okay, for 10 years if you are paying at beginning of each period, basically we have paid something today at day 0 where the present value factor is 1, and then we have made 9 payments, we can say at end of each year. Okay. Now, what is the discounting factor? 1 divided by 1.1 is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9. And if I do the grand total, I get present value annuity factor for 10% for 9 years is equal to 5.759. This is for 9 future payments, and 1 payment is made today. So, you will add 1 to this, plus 1 is equal to 6.759. Okay. 6.759 into 50,000 comes to 337,950, this number. As per me, that is the correct answer or correct option. Why? Because the question has not said that whether we have paid it before the commencement. Okay. So, at the commencement, the 10 leases are outstanding. So, that should be considered as a part of calculation. But in this MCQ, what they have taken as an assumption is that no, it is not 10 outstanding payment, it is only 9 outstanding payment. So, 50,000 into 5.759, that comes to 287,500. This is what they have considered as the correct option. In the RTP also they have done the same thing. And if you see the study material, in the study material they have considered 10 periods. Okay. So, there is slight inconsistency. If you get in the exam, maybe you have to follow this option only. Okay, that is the first thing. What is the value of right of use asset to be recognized initially? Right of use asset we know is lease liability plus your initial direct cost plus any advance payment. So, 287,500 plus 50,000 of initial direct cost plus 50,000 of advance payment plus 15,352,500. What would be the amount of depreciation? Now, if this is correct, divided by 10, if you do, you get 35250. All right. Okay. So, only thing where I have a contention here, and see, as per study material they have taken 10 years, here they have taken only 9 outstanding payments. So, that is where there can be a mismatch in the answer. And what would be the tax rate to be considered for the purpose of for 31st March of year 2? X Limited has deferred tax asset recognized in the balance sheet at 31st March in respect of unused tax losses that can be used to reduce taxable income in the future year. Tax rate used to calculate the deferred tax was 40%, which is the current tax rate applicable at the balance sheet date. New government came into power on 1st of April and passed a legislation that the income tax was reduced to 33%. Now, should we take 40 or should we take 33? Again, on the date of balance sheet, did we have an indication that a new government will be formed on 1st of April? We didn't know. Was there any discussion that new tax rate will come? No. Was it substantially enacted? No. On the balance sheet date, what is the enacted tax rate? 40%. So, we should take 40% as the answer. Now, here it is a small case. So, because it is a small case, we can read the case first and then we can move to the questions directly. Okay. A Limited enters into a 3-year contract to provide 1000 hours of standard call center operator time per annum for 6 lakhs, that is 2 lakhs per year. The standalone selling price at inception. At the end of first year, the contract is extended for another 3 years at 6,60,000 as follows. In accordance with the contractual provision, the fee for first year is reduced by 90,000 because of highly defective service. So, 2 lakhs was the fee for first year and they are saying was 90,000 you have to remove. So, for first year it becomes 1,10,000 net. That is attributable only to the first year. The contract is extended for another 3 years for 7,50,000, that is 2,50,000 per year when the standalone selling price is 2,30,000. Now, what they have done? They have said we will modify. Now, this modification of the contract, if you see, it has not happened at the standalone selling price. 250 was the standalone selling price. 230 is the standalone selling price and 250 is at which we will do. So, we will not account for it as a separate contract. Okay. Now, will we do a retrospective thing here? No, here we will be adjusting it prospectively. Government G has significant influence over L, L has significant influence over A and controls K. All the entities have transaction with each other. So, this is a separate question. Okay. What is the amount of revenue to be recognized in the first year? 2 lakh is the value, in that 90,000 is the penalty. So, 1,10,000 is the thing. What will be the accounting treatment for the contract extended at the end of year 1? It is to be accounted for prospectively, will be accounted retrospectively? No, because the services have already been provided for year 1. Then modification will be accounted for as no two separate contract, does not fall, no. So, option A is the correct answer. What would be the remaining total revenue of the contract for 5 years? Remaining total revenue of the contract for 5 years. So, what is the remaining total revenue? 3 years is 7,50,000. Okay, 3 years it is 7,50,000. First 2 years we have 4 lakhs to be paid. So, total revenue is 11,50,000. 11 lakh. See, the same question is there in one of the RTPs also. Okay, what amount of revenue is to be recognized in year 2? Now, year 2 will be 11,50,000 divided by 5, because 11,50,000 is the total consideration and 5 is the term. So, divide by 5, you get 2,30,000 revenue for second year. State which of the following statement is correct with respect to transaction between A, K and A and L Limited under Ind AS 24. So, what is the question? The question is between A and K and A and L Limited. Okay. So, let us see the thing. Government G has significant influence over L, that we are not even discussing. L has influence over A. So, L has significant influence over A and L controls K. So, L and K are related parties, L and A are also related parties. Okay. So, I will write it here, L and A, L and K, these are a part of the group and this is an associate of L. So, this also is related to K. So, what is the answer? What is the option? Transaction between A and L and A and K are not disclosable. A and L, A and K not disclosable. Wrong. A and L are not disclosable. A and L, no, because member of the group, no. So, this has to be disclosed. Wrong. A and L are disclosable. A and K, wrong. A and L and A and K are disclosable. Right. Okay, this is the answer. Again, I will tell you, whenever you get a related party question, draw a chart. That will help you to decide the related party relationship better. Next question. How should the omission of depreciation of investment property be corrected? So, that is it. With respect to point 2 above, how should ABC treat the situation in its financial statement? Again, revenue to be recognized and the amount of contract liability per membership. Okay, so 3 parts are there. First, ABC is a diversified company engaged in multiple lines of business. So, this is the introduction, no need to waste time on that. ABC has an investment property with an original cost of 1 lakh which it inadvertently omitted to depreciate in the previous financial statement. Property was acquired on 1st of April and useful life of 10 years, depreciated using a SLM method, estimated residual value is 0. We are preparing as on 31st March of year 4. So, year 1, year 2, year 2, year 3 and year 3, year 4. So, 3 years depreciation has not been charged, alright. So, the question is, how should the error be corrected? The error shall be corrected by restating the figures prospectively. No, see, any error has to be retrospectively corrected. Error shall be corrected by retrospectively restating the figures for year 2, year 3, but without presenting a third balance sheet at 1st of April, which is the beginning of the earliest period. Error shall be corrected retrospectively, restating the figures for year 2, year 3 and also by presenting a third balance sheet of 1st of April, which is the beginning of the earliest period presented. There is no error. So, this is gone, this is gone. Out of these two, we have to take a call. Okay. Now, the opening balance sheet needs to be presented if this is significant. Okay. Now, if you assume that, then option C will be the correct answer, right. Then, with respect to point 2 above, what is point 2? While preparing financial statement for year ended 31st March, ABC discovers that a provision for constructive obligation for payment of bonus to selected employees in corporate office material amount which was required to be recognized in the annual financial statement for the year ended year 2 was not recognized due to oversight. So, we are right now in what? Year 3, year 4. The bonus was paid during the financial year 3 and was recognized as an expense in the annual financial statement for the said year. Okay. Now, coming to this one, point number 2, is it an error? Yes. What is the error? First, it is an expense of year 2. We have recognized it as an expense of year 3. So, we have to remove from this. This will result in opening balances also being changed and also the amount is material. No adjustment is required. No, that is not the right answer because even though we have booked in the previous year, it should have been booked in the prior year to that. Okay. So, there is an error. Recognize the provision in year 3, year 4 as current year expense, not possible. Present a third balance sheet at the beginning and which would recognize the provision for bonus and restate the retained earnings, that is the correct answer. See, it was to be done in first year, we actually did in second year, we are right now in third year. So, correct the first year balance sheet and opening balance sheet. Okay. Disclose the omission in the notes to accounts without any retrospective adjustment, wrong. Here also one more angle you can look at is even the opening balance sheet at the beginning of the previous year will have an impact and hence we are doing a restatement. Point number 3. So, this we did yesterday only, right, same question is there. So, we can just try it. I think some 6, 7 some number is there 6, 8, 5, 7. Then again diversified organization introduction you can skip. So, here see when they have multiple things, no, each case we will have a separate question. Alright, first MS Limited acquired a heavy machinery at a cost of 1 crore with no breakdown of component parts. Estimated useful life is 10 years. At the end of 6th year, one major component, the turbine requires replacement. Again, a question repeated from the study material as further maintenance is uneconomical. Remainder of the machine is perfect and expected to last for next 4 years. Cost of new turbine is 45 lakhs. Discount rate assumed is 5%. So, for this, what is the question? Approximate cost of turbine at year 1 would be how much? Current carrying amount of turbine at the end of year 6 would be how much? Revised carrying amount of the machine after replacement will be how much? 3 points, right? Now, if you remember when we actually did this question in the class, the working was very much in detailed. The working was very much in detail. Do we need so much of detailed working? We don't need. We just need to be conceptually clear that we have to segregate this turbine from this cost. Now, this cost is at year 0. Turbine replacement happened at the end of the 6th year. So, 7, 8, 9, 10, 4 years are left, 6 years are completed. So, this we have to discount by 6 years to get to know out of this 1 lakh what is the turbine cost. So, that is the first question. Approximate cost of turbine in year 1 would be how much? Now, how do we do that? 5% is the discount rate. Okay. So, 1 divided by 1.05, 1, 2, 3, 4, 5, 0.7835. And you just need to do in rough. Don't waste time in following a proper format for this question in the examination. How many years? 6 years. 1 divided by 1.05. 1, 2, 3, 4, 5, 6. 0.746, not 7835. 0.746. 0.746 into 45 lakhs. 33 lakhs 57,000. 33 lakhs 57,000 is the cost at the beginning. Carrying amount of the turbine at the end of the 6th year of the turbine, not of the whole machine. So 3,375,900 is the cost. How many years are completed? 6 years are completed. So 3,357,900 into 6 are completed, 4 years are left. So what you can do, this divided by 10 into 4 you can do directly. Into 4 if we do, we get 1343,160. 1343,160. Alright. Then revised carrying amount of the machine after replacement would be how much? So what we will do is, see, this is a 1 crore machine. After 6 years, what is the carrying amount? Carrying amount is equal to 40 lakhs. See, directly we can calculate, no need to do a detailed working. Carrying amount is 40 lakhs. Out of that, this turbine is gone. So minus 40 lakhs, we get to 26,56,840 plus 45 lakhs. 40 lakhs minus 1343,160, 26 plus 45 lakhs, we get 7156,840. Simple and straightforward answer. Okay. So now the thing here you need to understand is, see, I have not even written down detailed steps. This we could calculate on calculator, this also we could calculate on calculator, this divided by 10, and this also we could calculate on calculator. That is the point I am trying to make here, right? You don't need to do detailed workings or steps for all of this. MS Limited measures its head office building using the revaluation model. Building is revalued every year on 31st March. On 31st March of year 5, carrying value of the building after revaluation was 40 crores, tax base is 22 crores. During the year ended 31st March, MS Limited charged depreciation of 2 crores and claimed a tax deduction of 1.25. On 31st March, the building was revalued to 45. In the tax jurisdiction in which MS Limited operates, revaluation PPE does not affect the taxable income at the time of revaluation. Now, what is the question? The charge to other comprehensive income related to deferred tax for the year ended 31st March of year 6 would be how much, right? Now, here this, if you ask me, is a very long question. Okay, this is a proper question which has been asked in the previous attempt also. Using the revaluation model, revalued every year, 31st March, carrying value of the building was how much? 40 crores, tax base is how much? 22 crores. So 40 minus 22, we get how much? 18 crores. What is this 18 crores? This is the difference. Whenever there is a gain, there will be a DTL, and what is the tax rate? Tax rate is 20%. Okay, tax rate is 20%. So 18 into 20%, you have 3.6 crores as DTL opening balance. Then, during the year ended 31st March of year 6, MS Limited charged depreciation in its statement of P&L of 2 crores and claimed a tax deduction of depreciation for 1.25 crores. Now, what happened is, from this 40, 2 is depreciated, we are left with 38. From this 22, 1.25 is depreciated, 22 minus 1.25, we get 20.75. What is the difference? 38 minus 20.75, we get 17.25 into 20%, we get 3.45. 17.25 into 20%, 3.45. Now, this is the DTL balance at the end of year 2, and now it is revalued to 45 crores. Okay, see, now what happens? It is revalued to 45 crores. Tax base is how much? 20.75. Revalued to how much? 45 crores. So 45 minus 20.75, we get a difference of 24.25 into 20%. Closing balance is 4.85. Closing balance is 4.85. Now, 4.85 is the closing balance, 3.6 was the opening balance, 3.6 would have come down to 3.45, correct or not? See, the thing you have to understand is 3.6 is an opening balance, and then because of depreciation, some part of it is reversed. Some part of it is reversed because of depreciation. Now, where does depreciation go to? depreciation is charged to P&L. So, this impact of 0.15 whatever is the movement goes to P&L. Okay. Then what are we left with? We are left with movement from 3.45 to 4.85. This will go to OCI. Are you able to understand the difference? Opening there was a DTL in OCI. This DTL reduced to 3.45, but that was because of depreciation. That impact goes to the P&L. From 3.45 now closing balance is 4.85. This goes to OCI. What is the question? The total deferred tax liability, the charge to other comprehensive income related to deferred tax for year ended 31st March would be how much? 1.4 crores. The total deferred tax liability at 31st March would be how much? Is there any other information? Yeah, so this also is the information, no? MS Limited has 40% shareholding in N Limited. MS Limited purchased the shareholding for 45 crores. Shareholdings gives MS Limited significant influence but not control. They account for equity method. The equity method carrying value of MS Limited investment is 70 crores on 31st March and 75 crores on 31st March of year 6. In the tax jurisdiction, profits recognized under equity method are taxed only when they are distributed or when the associate is disposed of. Now, what is the question? Question is the total deferred tax liability as on 31st of March of year 6 would be how much? So, one is this 4.85. Second, here 45 became how much? 75. So, gain is how much? 30, because they are not asking charge to P&L, they are asking closing balance. 30 into 20% is 6. So, 4.6 plus 4.85, totally we get 10.85. Option D the correct answer. Okay, option D the correct answer. Now, the same question if it was asked in descriptive as asked in the previous attempt, the solution would have been much more detailed. We need to figure out how to do it in shortcut and get to the MCQ answers. So, again individual loans, individual transactions here and individual solutions we are looking at. XYZ Limited originates 2000 bullet loans with a total gross carrying amount of 5 lakhs. XYZ segments its portfolio into borrower groups X and Y on the basis of credit risk characteristics at initial recognition. Group X comprises of 1000 loans with a gross carrying amount per client of 200 for a total gross carrying amount of 2 lakhs. So, X is 1000 into 200. Group Y comprises of 1000 loans with a gross carrying amount of 300 for a total carrying amount of 3 lakhs. There are no transaction costs and the loan contract include no options, premium or discounts. Additional information. Historic per annum average default 4 and 2. Present value of observed loss assumed 600 and 450. Okay. Now, what is the first question? Calculate the loss rate of group X and calculate the loss rate of group Y. Now, what is group X? Group X we have how much? 2 lakhs. What is the loss rate assumed? 600. So, 600 out of 2 lakhs if I do 6 divided by 200 I get 0.3. 6 divided by 2000 into 100 0.3. So, group X has a loss rate of 0.3%. Group Y 450 out of 3 lakhs. So, 450 3 lakhs means 0.15%. Okay. That is it, simple, straightforward. Then X Limited invested 40% in share capital of N Limited and it is an associate. N Limited sold inventory to XYZ for a value of 10 lakhs, includes profit of 10%, transaction that is 1 lakh. Out of the above inventory, XYZ Limited sold inventory of rupees 6 lakh to outsider, 4 lakh is still lying in XYZ. So, 4 lakhs is lying. In 4 lakhs, that is the purchase value, 10% on the transaction price into 10% is our profit. So, 4 lakh into 10% is 40,000. 40,000 mein our share is 40%. If our share is 40%, elimination should be for 16,000, right. Now, where will we eliminate this from? From inventory, because XYZ still has the inventory. The unrealized profit to be eliminated on the sale of inventory will be 16 lakhs. Oh, sorry, 16,000. In case N Limited sold inventory to XYZ, the value of inventory appearing in the consolidated financial statement as on 31st March would be how much? N Limited sold inventory. Okay. So, out of that, what was there? 4 lakhs was the cost of inventory minus 16,000 is the unrealized profit. Please remember, if the entity sells it to an associate, we will remove from the investment value. If the associate sells to the entity, we will remove from the inventory value. So, 4 lakh minus 16,000, 3 lakhs 84,000. In case XYZ sold inventory to A Limited, unrealized profit would be reversed by debiting which account? Associate. If you have done, then investment account would be, sorry, profit to be eliminated by, no, we will credit the investment account and we will debit the sales account to remove the impact. Okay. So, we will reduce from investment. Question was what? Debiting which account? So, that is the answer. So, this is what I am saying, reduce from the investment account. Next, Tara Limited, this is from a past exam question. Okay, so I think you can practice it on your own. I have already done it separately, because I know it may not be repeated and whatever it is, you can do it as your own practice. I have already solved this here. Next, Planet Limited, long question. So, after negotiation with nationalized bank, how the long term loan should be classified? See, there is an amendment, but that amendment is applicable only from 1st of April of 26 financial year. Okay. So, in your exam that will not be applicable. What will be the impairment loss for associate, amount of goodwill, accounting treatment for renovation? So, 3 numbers are there. Now, because this is a longer case, let us pay attention and see how to solve it. Planet Limited is a multinational company, okay. One of the segment is manufacturing, okay. Company raised a loan for 1 crore from nationalized bank to purchase certain plant and machinery for agriculture segment during the year ended 31st March. The loan is repayable over a period of 5 years. Terms and conditions of the loan is that the company should maintain a current ratio of 1.5 and debt of 1:2. These covenants fall if the below this level, then the bank can recall. The unpaid loan as on 31st March was 85. The current ratio was 0.9:1. So, this failed. Date was 0.65:2. This also failed. No, this is not failed. 0.65:2 is better actually. They want debt of 1:2. So, this is better. Okay, very unlikely that if it is debt level is below, they will recall. Okay, very unlikely. Current ratio was 0.9:1. They should have maintained what? 1.5. This is definitely failed. The bank has sent a notice on 7th of March demanding repayment of loan on account of breach. Financials were approved and signed on 15th of May. After receiving the notice, CFO of the company contacted the bank and ensured to rectify. On 20th May, the bank agreed not to recall the loan and allowed to achieve the debt equity ratio by the end of 31st March of year 3. Now, is this a current or non-current? See, whenever there is a breach of contract and if the bank has not waived off the right to recall the loan till the time the financial statements have been approved, it will be classified as a current liability. Here, the approval came after, when on 20th May. So, this will be a current liability. So, the classification will be what? Non-current financial, other non-current, current financial, other current financial liability. Okay. Then, Planet has recently acquired shares in Bean and Camel Limited and prepared draft CFS in accordance with Ind AS for the year ended 31st March. Value non-controlling interest at fair value of NCI on the date of acquisition was 1430. Following information is relevant regarding the acquisition of shares. Retained earnings 5400 6240, purchase consideration 10,000 5760, 8540. Subsidiary, associate. In the draft consolidated financial statement prepared on 31st March, financial relating to Bean and Camel appeared as follow. Bean issued ordinary shares 3600, retained earnings 4000 7400. Okay. Bean and Camel have not issued any share capital since acquisition. Fair value of net assets and Camel Limited were same as their carrying amount on the date of acquisition. Planet has significant influence over Camel. Okay. Impairment loss of 204 lakhs have been identified in respect of goodwill arising on acquisition of Bean for the year ended 31st March. Recoverable amount of net assets of Camel Limited has been deemed to be 11,760 on 31st March. On 1st Jan, Planet sold inventory costing 45 lakhs to Camel for 63. Inventory was unsold. Inventory was sold to a third party on 8th of April after the financial year end. They had constructed a shopping mall earlier. Company renovated a portion of the mall, constructing food court, etc. Food court, gaming zone are expected to result significant increase in sales. This has to be a part of PPE. Okay. So, first we have done second. What will be the impairment loss from investment in associate for the year ending 31st of March of year 2? So, on 31st of March of year 2, what will be the impairment loss from investment in associate? Now, for that, what do we need to do? We need to calculate carrying amount. Okay. So, first, purchase consideration. Okay. Camel Limited, right? So, cost is 5760. Net assets, share in net assets is 40% of 6240 plus issued ordinary share capital 4000. So 6240 plus 4000 into 40%, we get 4096. Okay, consideration is 5760 minus 5760, we get goodwill of 1664. We get goodwill of 1664. Okay. Now, if it is a goodwill case, our cost of acquisition will be 5760 only. Sir, why did you calculate? I calculated because if there is a capital reserve, my carrying amount of investment will change. Okay. So, now for me carrying amount is how much? 5760 is the purchase consideration plus share in profit 7400 minus 6240. 7400 minus 6240, this is 1160 into 40%. This is 464. Okay, that is the second thing. Then there is an intercompany transaction as well. Planet sold inventory costing 45 lakhs to Camel for 63 lakhs. Inventory was still unsold by Camel. So 45 to 63, 63 minus 45 is 18. So this will be reduced because the inventory is lying with associate. I have to reduce that. 18 lakhs of unrealized profit into 40%, that is 7.2. So carrying amount is 5760 plus 464 minus 7.2, 6216.8. Okay, this is the carrying amount. Now what is the recoverable amount? Recoverable amount, what they have said is 11760. 11760 into 40% is our stake, 4704. Carrying amount is how much? 6216 minus 6216.8. I get 1512.8. See, this took a lot of time to calculate. So some questions you will definitely get where you will have to spend a significant amount of time in calculating. Okay, so that is one thing you have to keep in mind. It is not that all the questions are straightforward, simply you can calculate. Okay, so 1512.8 is the impairment loss. 1512.8. I hope it is correct. Yeah, done. What will be the amount of goodwill as on 31st March of year 2 arising from acquisition of Bean Limited? So goodwill means, what do we need? We need retained earnings on date of acquisition 5400 plus share capital Bean Limited, no, 3600 plus 3600, 9000. 9000 is the fair value of net asset. So where is the impairment they have written? 204, right? So 9000 is fair value of net asset. What is my purchase consideration? My purchase consideration is 10,200. 10,200 plus NCI fair value. Fair value of NCI is 1430 plus 1430. So that is 11630 minus 9000, 2630 minus impairment of 204. So 2426. 2426 is the answer. Now this 204 of loss will be split between 85% parent and 15% NCI. So 85% goes to parent and 15% goes to NCI. Carrying amount is 2426. Is it correct? Carrying amount is 2426. Now this is a detailed working and we saw how we can solve it on the calculator as well. Alright. Lastly, what should be the accounting treatment for cost incurred for the renovation? Okay, what is the accounting treatment to be done for cost incurred for renovation? This has already been asked in the examination as well, right? Now what has happened here? Company renovated a portion of mall by constructing food court, spa and gaming zone. Food court and gaming zone are expected to result in significant increase. Food court and gaming zone. So only food court and gaming zone should be capitalized. Food court and gaming zone should be capitalized. That is the answer. Alright. So small only, but still net asset value will be, purchase consideration will be, treat the consideration contingent consideration. This should be fair value of net asset anyways. Nikhil acquired 100% of Pranav Private Limited on 1st of January. Fair value of the purchase consideration was 20 crores. Ordinary shares of 100 each of Nikhil Private Limited. Fair value of net asset acquired was 15 crores. At the time of acquisition, value of ordinary shares and the net assets were only provisionally determined. So if it is provisionally determined, we have 1 year of the time. Okay. So right now net asset value is 15. On 30th November, it was finally determined that fair value of Nikhil Private Limited shares was 22 and fair value of net assets of Pranav Limited was 16. So, now it is 16. So, 16 should be the value. However, directors of Nikhil Private Limited have seen the fair value of shares decline since 1st of January. When did we buy? 1st of January of year 1 and wanted to adopt the fair value of shares as on 1st of February of year 2. I think this should be year 2, which will result in the fair value consideration being 18 crores. See, 1 year we have time. So, till 1 year whatever is done, that is what you have to consider. In addition to above purchase consideration, acquisition agreement states that additional 4 crores will be paid if they achieve a turnover of 160 in the next 2 years. The fair value of the said consideration was 3 crores. On February, it is determined that it will be unlikely that it would meet the budgeted turnover of 160 crores. Now, net asset value will be 16 crores. Purchase consideration will be 22 crores of shares and fair value of this consideration is 3 crores. See, whatever happens after the 1 year period ends, that we will not consider. So, 22 plus 3, 25 crores. Treat contingent consideration that has been paid by the company. Okay, so what should you do? Nikhil should not recognize the consideration? No. Nikhil should disclose the consideration? No. Nikhil should recognize the fair value of the consideration as a part of business combination, increasing goodwill and remeasure it at the end of reporting period. It will be recognized in the statement of P&L. Option C, correct answer. Again, independent MCQs, so we will do one by one. Okay. See, longer case MCQs, first we will read the MCQ requirement and go on to the question. Otherwise, we can do one by one. Raja Limited, a leading public limited company engaged in the manufacture of pharmaceuticals, prepares its account as per Ind AS. Okay, fine, 31st March of year 2. On 1st April of year 1, Raja Limited held 35% of the equity shares of Volga Limited, associate company. Carrying value of the investment in Volga Limited on 31st March of year 1 is 1,50,000 in the CFS of Raja Limited. I think they meant year 2 because acquisition itself is on year 1. Let's see. During the financial year ended year 1, year 2, Raja Limited sold goods for 350 to Volga Limited. The cost of goods sold is 3 lakhs. Out of these goods costing 1 lakh to Volga Limited were lying unsold with it on 31st March. During the year 31st March of year 2, statement of P&L of Volga Limited showed a profit of 25. They declared and paid a dividend of 10 lakh to its equity shareholders during 1-2. Determine the value of investment in Volga Limited as on 31st March in the CFS of Raja Limited if equity method is adopted for valuing investment. Now, for these type of questions, right, before we jump into the inventory adjustment, I want to give you a shortcut. Shortcut means what? See, cost is how much? 150. Okay. Then earnings is how much? 25. Dividend is how much? 10. So, net what will happen? 25 minus 10, 15 lakhs. 15 lakhs into our share is 35%. So, 5.25. Total is 155.25. Okay. Now, quickly see the options. 155.25 is one. This is not the one. Okay. This is not the one. 158 is also not there. Now, either 155.10 or 155.20. Now, 5,000 cost of goods sold is 3 lakhs and this is 50,000. So, 5,000 is unlikely. Okay. 5,000 is unlikely. So, the value of investment in Volga Limited as on 31st March will be how much? That is what is the question. So, 5,000 unrealized profit will be unlikely. Okay. Now, second thing is 155.25 and Raja sold goods to Volga and the cost of goods sold is 3 lakhs. So, unrealized profit is 50,000 for 3 lakhs. Okay. Into how much is lying unsold? 1 lakh is lying unsold. So, into 1 lakh. So, 50 divided by 300 into 100 if I do 16,000.16 is the unrealized profit. So, 155.25 minus 0.16 that will be 155.09. Okay. Now, we will calculate 155.09 and we may mark the answer. But once again check, Raja held shares in Volga and goods costing 1 lakh to Volga Limited. Who sold? Raja sold to Volga. So, we have to reduce it from the investment only. Okay. So, the answer is 155.09 is what we got. 155, nearest is 155.10, that should be the answer. Let us see what they have done. Oh, okay. Sorry. Goods costing 1 lakh to Volga Limited were lying unsold. My bad. So, this has to be 350. because 1 lakh is goods costing to Volga. So 50 divided by, see, we can make this mistake, and I have already solved this question once, in a live MCQ discussion for a past exam paper. I have already solved it and still I missed it. So 50 out of 350 into 1 lakh to Volga Limited, cost of goods sold is 3 lakh, 350. So 1 lakh divided by 350 into profit is 50. So 1000 into 50 divided by 350, we get 114. So 155.25 minus 14, 155.25 minus 0.14, we get 155.11. Again it doesn't match. Arey yaar, 35%. Someone should correct me, no, on live. See, I missed again, two things I missed, into 35%, right? So 155.25, 0.14 into 35% minus 155.25, we get 155.20. So 155.20 is the correct answer. My mistake, I will tell you what all mistakes did I do. I took cost to Volga. I should have taken, I took cost to Raja, I should have taken cost to Volga. Second, I missed out the 35% trying to do it faster. So please keep in mind. And again, even after solving this on live correctly, okay, when I had done earlier, I had done it correctly, I made a mistake here. Don't do that mistake. Raja held 50% of voting power of Sharp Limited, which is a joint venture of Raja Limited. The carrying value of 1st April of the investment in Sharp Limited as per equity method is 50 lakhs. On 1st of July, out of 50% stake, Raja Limited sold 20% stake in Sharp Limited to an unrelated entity for a consideration of 40 lakhs. Now here in this question, there are two assumptions possible. So I think if the institute updates this, then only we should be doing it. Okay. Acha, they have updated it here. It is to be noted that equity method of accounting needs to be discontinued. Okay, fine. So Raja holds 50% of the voting power of Sharp. So we follow equity method. Now on 1st of July, out of 50%, Raja's Limited sold 20% stake to Sharp Limited. Now the reason why they have mentioned that equity method is to be discontinued, the reason for that is because even if you come down from 50% to 30%, okay, even if you come down from 50% to 30%, what will happen? 20%, 30%, you will still follow equity method. Okay. So in the main exam questions, both the assumptions were possible. Now they have clarified it that equity method has to be discontinued. All right. So out of the 50% stake of Raja Limited, they sold 20% to an unrelated entity for 40 lakhs. Fair value of the retained 30% interest is 60 lakhs. It is to be noted that equity method has to be discontinued. Now what is the question? Determine the amount of gain or loss to be recorded by Raja Limited for disposal. Okay. Now when you dispose of, carrying amount is how much? 50 lakhs. Current carrying amount is how much? 50 lakhs. You sold it for how much? 40 lakhs. You got 40 lakhs. Existing stake is having a value of how much? 60 lakhs. So 40 lakhs is what you got, 60 lakhs is what you still have, and 50 lakhs is the carrying amount. So 1 crore versus 50 lakhs, gain will be how much? 20, 30, 50, 50 lakhs. Okay. Then on 1st August, Raja Limited acquired 70% shares in S by paying cash consideration of 97,50,000. The fair value of identifiable net asset is 1 crore 30 lakhs. Fair value of 30% shares owned by NCI is 25 lakhs. Carrying amount of net identifiable asset in S Limited is 1.2 crores. They choose to measure the interest of NCI shareholders at fair value. What is the question? Determine the amount of goodwill or gain on market purchase arising at the time of acquisition of S Limited. Cash consideration 97.5. Fair value of identifiable net asset of S Limited 130. Fair value of NCI 25. Carrying amount we do not care. Okay. So is there any tax rate? No tax rate is given. So 97.5 plus 25, we have 122.5. Here it is 130. Okay. So net asset is 130, payment is 122, gain is how much? 77.5. This will be the gain. So there will be a gain on bargain purchase of 7,50,000. Simple, straightforward. Next, XYZ is a manufacturing company. Okay, again we have 1, 2, 3, 4 individual numbers. Okay. During the year of year 3, year 4, XYZ purchased a special type of packing material from an US based company for $14 lakh on 1st of December of year 3 when the exchange rate was 75. American company provided with 5-month interest free credit. At the reporting date, the exchange rate was 77.5. As of 31st March, 60% of raw material purchased was still in inventory. Functional currency is Indian rupee. Determine the amount of exchange loss or gain to be recognized in relation to purchase of raw material. Now here, when I actually, this is also an exam question, when I was actually doing it live, a lot of students were saying, sir, because it is in relation to inventory we should not restate. See, the objective of the question is not to ask you an inventory restatement. The question is asking basically on the payment to the supplier, how much will be the loss. So loss will be how much? 75 has become 77.5, 2.5, and it is 14 into 2.5, 35 lakhs. 35 lakhs is the loss, that's it. So the loss is 35 lakhs. Second, in order to motivate and retain employees, XYZ announced on 1st of April a scheme of granting 6 SARs to 400 employees who remain in organization for next 3 years. Other information available on the portal relating to the scheme is as under. So fair value of SAR 100, 110, 116, 400, 390, 380. SAR are vested at the end of 3 years based on the condition attached to the SAR scheme. What is the question? With respect to share appreciation right, determine the balance of liability at the end of 31st of March of year 4 and expense for the financial year ended 3-4. Okay. Now here again, no need to start from year 2. They have asked us closing balance on this date. So that will be how much? 380 into 116. Fair value of SAR, and each is given 6 into 6. 380 into 116 into 6, you get 264480. What is this? This is the closing balance of liability. Okay. So come to the options. You have 2 options with this number. Now expense is 171 or 92. Again, no need to do fully. What you have to do is 110 into 390 into 6. This was 257,400 closing balance. Okay. 257,400 closing balance at the end of year 3. Out of this you would have done divided by 3 into 2. So the closing balance would have been into 2 divided by 3, 171,600. I am repeating once again. At the end of year 3, what you would have done? 110 into 390 into 2 years divided by 3. That is the closing liability balance. That much of expense you would have already booked. Now closing balance is minus 264480. So expense should be 92880. So 92880. Option C is the correct answer. Is it correct answer? Option C is the correct answer. Okay. So period 1 calculation is not required in this particular question because period 2 closing balance is this, and we know period 3 closing balance is this. Then with respect to OCD, the borrowings of XYZ include 10% optionally convertible debentures issued on 1st of October for 50 lakhs. These debentures are convertible into equity shares of XYZ at the option of the holder at the end of the tenure, 5 years in the ratio of 1:1. Each OCD will be converted to 1 equity shares. Interest is paid annually. Market rate for without conversion option is 14%. Now what is the question? With respect to OCD, determine the finance cost that will be charged for 31st March of year 4. When did they issue? They issued on 1st of October of year 3. So, and it is a tenure of 5 years, 10% into 50 lakhs is equal to 5 lakhs and 50 lakhs of principal. This is interest, this is principal. What is the present value factor? For 5 years 14%, 1 divided by 1.14, 1, 2, 3, 4, 5. This is 0.5193. Okay. I will do an M plus for this. Then grand total 3.433. This is into 3.433 into 5 is equal to 17.165. Okay. MRC into 50 is equal to 25.96 plus 17.165, 43.13. This is the liability component. 43.13 into 14% divided by 2, 301934. 301,934. So 301,949. That is the correct answer. 301,949. Okay. Then lastly, share capital includes 10 lakhs 12% cumulative preference shares. Company has arrears of 2.4 crores of preference dividend. It includes current arrear of 1.2 crores. Company did not declare any dividend for equity shareholders as well as preference shareholders. What is the question? Determine the amount of preference share to be reduced. Now here a lot of students have this confusion that dividend means fully to be deducted. No, if it is cumulative, you will deduct only current year dividend. You will not deduct the full arrears of dividend, only current year 1.2 crores. This we already solved it, same question like we did yesterday. Savita Public Company, okay, they have following closing stock of finished goods as on 31st March, quantity, cost, estimated selling price, selling cost. Associate company, okay. Value of closing inventory of raw material, so that is the problem. So this again they have not updated, okay. They have not updated this question. Earlier also the question was having, the question has raw material as testing and they have mentioned closing stock. So that is not correct actually, but that is what they have done. This is also past exam paper, okay. They have not updated, they have given as it is what is the closing stock of raw material, okay. So we have to assume closing stock of finished goods. The question also should be for finished goods, all right. Now what is the closing stock? Cost is 88, 110 minus 5, 105, 495 minus 46, 495 minus 46, 449. So 449 here and 88 here, lower of cost or NRV. 88 into 1000, 1000 M plus, and 449 into 300 M plus MRC, 222700. 222700, that is the answer. What is the classification of land at Kota on 31st March? They purchased land at Kota whose future use was not determined. If future use is not determined, it will be classified as investment property, straightforward. Then remaining part you have already done, you can continue with that. Beta Limited will record 85 and disclose the investment at level 2 measurement as per Ind AS 113 as on 31st of March. Level 2 inputs are quoted price unadjusted in the active market for identical assets and liabilities the entity has access to. The entity can access at the measurement date. So what is that we have to see? Savita Limited developed a new drug, was final phase of clinical trials. Beta Limited had an equity investment in Savita Limited. Beta determined that Savita shares had readily determinable fair value and accounted it as a VTPL. On 31st March, Drug Approval Authority notified that the drug was not approved. Share closed at 112. They issued a press release after the market close announcing the failed clinical trial. Shares opened at next working day at 40.85. Right now here, though the closing price is 112, we know it is not reflecting the closing price because there is an event which has happened and which could impact the price and make it 85. All right. Now here, what are the two statements I have said? Beta Limited will record the share at 85, yes, and disclose it as level 2 as per Ind AS 113, yes, because though it is the fair value on 31st March is higher, we know that actual fair value is only 85. Level 2 inputs are quoted market price in active markets for identical asset. This is wrong. So 1 is true, 2 is false. 1 is true, 2 is false. Option C is the correct answer. Omega Limited is one of the associate companies of Savita Limited. Omega has provided you the following information: net profit and all of this adjustment. On the basis of the information provided to you above, you are required, cash flow from operations. Cash flow from operations for financial year 3, year 4. Now cash flow related questions, you can just use the calculator and do it. Net profit after tax. We need net profit before tax. Is there anything for tax? They just have taxpayer information. They don't have any other tax information. So even if you add and reduce, it will be the same. So directly start from 93.4. 93.4. Then decrease in account receivable. Decrease means we have collected more, plus 42.5, plus depreciation 24.9. Increase in inventory, we purchased more, so reduce the cash flow, minus 31.3. Increase in accounts payable, we paid less, so plus 12.7. Decrease in wages payable, we paid more, plus 5.7. Sorry, minus 5.7. Minus 5.7. Increase in deferred tax asset, what will that happen to the P&L? If deferred tax asset increases, P&L will also increase. So, you have to reduce that back, minus 1.5. Profit from sale of land. Profit from sale of land, how much is this? 3.4. So, this also you have to reduce, minus 3.4. 131.6. 131.6 crores. 131.6. Now, what I am saying is this tax paid 21.8 and this 21.8 knocks off each other, and increase in deferred tax asset is a separate adjustment. No one need to write down all of these, just do this calculation, done. Okay. Next, Soumya Limited manufactures and sells various paper products and related machinery and equipment. On 1st of January of year 1, Soumya Limited sold a machinery for 42 lakhs to a new customer. To get into a long-term relationship with the customer, terms of sale include after sales provided free of cost for the next 4 years after the initial warranty period of 1 year. In general practice, the company sells the after sales service contract separately after the initial 1 year warranty period at 741. So, this will be what? Split. Okay. Sold a machinery for 4202230 and 741570. What is the total? 4202230 plus 741570. Total is 3800. Okay. What is the question? Revenue for machinery sold. So, you have 4943800, that is the denominator, divided by, so basically what you do is 42 divided by 49 into 42, correct. So, what I do is in the calculator normally I write this total 4943800, it works only on this type of calculator, may work in Casio also, you can try, divided by how much? 4202230 is equal to, I get 1.17, I do divided is equal to, I get 0.85 into 4202230. So, 3571896. 3571896. Okay. The value of closing inventory of computer paper, 5000 packets of computer paper. Inventory as on 31st March recorded at a carrying amount of 340 per packet, market price is 280 per packet. Soumya had a firm sales contract with Javin Limited to sell 2760 packets at 380, which cannot be settled net. Estimated incremental selling cost is 20 per packet. So, actually my pencil has gone off, so I will just show it to you here. Firm sale contract you have 2760, other inventory you have 2240. Okay. Now, what is the cost? Cost is 340, and NRV is 280 for normal and 380 for firm sale contract. So, 380 minus 20 and 280 minus 20. Now, here Institute has done different answers in different attempts. Here what they have done, they have taken total cost, okay, total cost and total NRV. So, total NRV means NRV of first and NRV of second, total NRV and total cost, and have done at NRV. In some of the RTPs what they have done, cost of 2760 and NRV of 2760, cost of 2240 and NRV of 2240, both assumptions they have taken. Latest one is this one where they have taken combined basis. So, we will also do it on a combined basis. Soumya Limited bought 100 acres of land for growing bamboo product for paper production. On October 1st, Soumya Limited purchased 10 dogs for security of aforesaid land. Okay. So, what is the third option? Purchase of dogs of Soumya Limited, will it fall under Ind AS 41 or not? See, please understand, if they have purchased it for security purpose, okay, purchase it for security purpose, it will not fall under Ind AS 41, it will fall under Ind AS 16. Second, Ind AS 41 applies to agriculture produce at the time of harvest, not prior or subsequent to the harvest. Yes, that is also a correct statement. Both 1 and 2 is true, but 2 is not the explanation of 1. Okay. Soumya Limited manufactures and sells various paper products and related machinery and equipment. Soumya acquired software for its internal use costing 320. Again, why am I reading the case scenario first? Because there are different bits. Different bits means I can read and get to the solution. Okay, so they acquired costing 320. Amount paid for the software was 1 lakh immediately, 2,20,000 in 1 year's time. What do we need to do with this? We have to bring it to the present value. Incurred purchase tax of 24,000 and entry tax of 10% recoverable from the tax department. Now, if something is recoverable, no need to compute, because What will the question ask us? The question will ask us what is the value of intangible asset. So, no need to compute this. And legal fees of 42,000, cost of capital is 10%. So, what is the cost of this particular intangible asset? 2,20,000 will pay after 1 year divided by 1.1, that is the cost of capital, plus 1 lakh, that makes it 3 lakhs. Then purchase tax of 24,000 plus 24,000 plus legal fees of 42,000. So, 3,66,000 should be the answer, option number C. They obtained a loan of 50 lakhs from Wood Cooperative Bank and paid 1% at processing fees and commitment charges. In May 7, Soumya availed a fresh loan of 30 lakhs from Iron Cooperative Bank to pay off the old loan taken from Wood Cooperative Bank. So, here it looks like there is an existing loan, alright, and because there is an existing loan, they have taken one more loan to repay the original loan. The company paid 20,000 as prepayment premium to Wood Cooperative Bank to clear the old term loan and paid 1% processing fees to Iron Cooperative Bank. Alright, just let me check if everything is fine. Yeah, everything is fine. Now, is it a modification? See, whenever there is a modification to a loan as per Ind AS 109, what we have to see is who are the parties. Here, one is Wood, second is Iron. So, two different banks. So, it cannot be a modification. Wood Cooperative loan is a separate loan. Iron Cooperative loan is a separate loan. So, what is the question? Unamortized processing fees of old loan will be what? So, what will happen to the unamortized processing fee? So, actually, you know, when we follow the effective interest method, automatically it will get captured in the interest rate. Whatever is the balance that has not yet been expensed. Sir, how do we say that? What happens is interest plus some part of processing fee. Okay, this is what you charge to the P&L. Now, whatever is unamortized, what will we do with that? Will we add it to new loan? No, it's a separate loan. Charge to OCI? Not possible. Charge to statement of P&L. Transaction cost of effective interest rate for new loan. Again, this is not there. Option C is the correct answer. Soumya purchased a building in Chandigarh on 1st of September for its administrative purpose, PPE. Due to some policy changes of the government, it relocated its office to Delhi in April 7. On 1st of May, Soumya leased out the building to Mrs. Lessee. So, what happens? PPE, now this will become investment property. What is the question? Soumya should reclassify the lease building from property, plant and equipment to investment property. Yes. Reason: a change in classification of building from PPE to investment property due to change in the purpose for which it is held is considered to be a change in accounting policy. Now, the purpose itself is different. The asset itself is different. Earlier it was property, plant and equipment. Now it is investment property. So, can we consider it to be a change in accounting policy? No. Do we classify? Yes. So, 1 and 2 are true, wrong. 1 and 2 are true, wrong. 1 is true but 2 is false, correct. Alright, easy. Okay. Now, I will tell you each of these questions, you can expect to come in the examination. They may appear simple but highly scoring. I hope it is clear. Moving on. Next, Hans is engaged in the business of manufacturing different location. For now, you can ignore. If at all we need, we will come back. And long cases, so let us see. Amount of share based payment to be recognized. Provision for illegal use of automotives. This we have already discussed, same repetition. Finance cost of preference shares issued for the year ended 31st March. So, first is related to share based payment. Okay. As per company policy on 1st April, Hans Limited agreed 15,000 share options each to its 3,000 employees. Options are due to vest on 31st March of year 5, 1. So, 2, 3, 4, 5, 4 years. Provided the employees remain in employment as on 31st of March of year 4. Acha. So, employment you need to be only till year 4. So, 3 years. On 1st April of year 1, directors of Hans Limited estimated that 80% of the key employees would satisfy the vesting condition. However, actual employee turnover was such that estimate was revised to 82% on 31st March of year 2, 92% on 31st March of year 3. When did they ask? Statement of P&L for year 2, year 3. So, we are bothered about year 2, year 3 only. Okay. On 1st April of year 1, the fair value of each share option was estimated at rupees 3. Now, please remember, please make a note of it. I have seen a lot of students doing this mistake. This fair value should not be changed. This fair value should not be changed. Hans limit estimate was revised, no problem. They correctly recognized this transaction in the financial statement for the year ended 31st March, but however the company did not make additional adjustment in the financial statement for year ended 31st March of year 3. So we are asked about year 2, year 3. Now here fundamentally there is an issue with the institute question where they say it will vest on 31st of March of year 5 provided the employee remain in employment as on 31st March of year 4. Now they have confused the service condition and the vesting period here. Service is required only till 31st of March actually, and it will vest on 31st March of year 5. Sir, can it vest after the employees leave the organization? Yes, it works that way. Okay, in real life even after the employee leave the organization it will vest, and that is how it has to be done. But what they have assumed is it is a 4-year period, and accordingly they have solved this question. So that is where there is a slight conflict as far as if you ask me. Now what to do in the exam? Now same thing has come in the examination. If you apply 3 years and do, you will not get the answer. Okay. If you apply 4 and do, then you will get the answer. Alright. So what is the question? Year 2, year 3, what is the number? Alright. So for calculation of year 3 and year 4, year 2, year 3, we need to know how much was done in year 1 and how much was done in year 2. Both these we know. We cannot do a shortcut adjustment. Okay. So how many employees? 3000 employees. So I'll just write it here. 3000 employees. How many shares? 15,000. I'll just write 15 so as to save time. Okay. Then service period is 3. Now turnover was such that the estimate was revised to 82%. Now should we start with 80% or 82%? We are booking on 31st March of year 1. This is year 1. So we will take 82% only. And what is the fair value? Fair value is rupees 3. So opening fair value is only relevant, subsequent fair value is not relevant. This is year 1. Then in year 2 what happened? 3015. What percentage are we expecting? 92% of 31st March of year 3. This is year 1, year 2, this is year 2, year 3. And what is that number? 92%. And this is 5. Okay. How many years? 1 out of 4, 2 out of 4. That's how we can do the calculation. 3000 into 15 into 82% into 5 divided by 4, we get 46125 here. 3000 into 15 into 92% into 5 into 2 divided by 4, we get 103500. Okay. Minus 46125, 57375. So I wrote 5 here. I kept on telling you have to take 3 and I wrote 5 here. This is 3. Okay. So say I am telling you to write 3 and I myself wrote 5. Okay. So can happen. 3000 into 15 into 82% into 3 divided by 4, this is 27675. 3000 into 15 into 92% into 3 divided by 4 into 2, 62100, 62100. 3000, 15, 92, 3 minus 27675, 34425. 34425 is the correct answer. Okay. 34425 is the correct answer. This is not 82%, this is 92%. Alright. Okay. Then next. This we have already discussed, so I am not doing it again. Then on 1st April, Hans Limited issued preference shares for a consideration of 10 lakhs to an investor. Holder has an option to convert these preference shares into a fixed number of equity shares of Hans Limited anytime up to a period of 3 years. If the option is not exercised by holder, preference shares are redeemed at the end of 3 years. The preference shares carry a fixed coupon of 6% per annum, which is payable at the end of each year. Prevailing market rate for similar preference shares without the conversion feature is 9%. Now here it will be converted into fixed number, but it is optional. It can be converted, it may not be converted. What is the requirement of the question? What will be the finance cost of preference shares issued by Hans Limited for the year ended 31st of March of year 3? Now here what do we need to do? We need to figure out what is the present value of the liability. then accordingly calculate. Now, how to eliminate the option if at all options are very close by? See, 6% is the coupon and 10 lakhs is the rate and 9% is another rate. So, 10 lakhs into 6%, 60,000 will not happen. 10 lakhs into 9%, 90,000 will also not happen. That is very clear. Okay, 6 lakhs into 10% will also into 6% and 9%, both of these will not happen. Now, either it will be 55 or 83, 150, one of these two. How to do the approximation? Now, see, it is more likely to be higher than 6% and lower than 9%. Okay, so most likely it will fall here, gap is higher, so we can do it, but still if you do not want to take a chance, we can actually do the calculation. What is the calculation? 10 lakhs, 6%, 3 years. So, 10 lakhs into 6% is 60,000 for 3 years at 9%, 3 years we need to calculate, and principal is 10 lakhs, 10 lakhs only, no, yes, 10 lakhs for 9% at the end of 3 years. These two numbers we need to calculate. Okay. So, how will we do this? 1 divided by 1.09 is equal to 1, 2, 3. So, this is 772,183 grand total into 60,000, 151877 plus 772,183, 924060, right. So, because if you look at the number of questions that we have calculated or that you have seen so far, this equity component is generally lesser number, right, somewhere around 76,000 only. Maximum portion is towards the liability component and the rate is 9%. So, if you multiply by 9%, you get 83150 or 83165 approximate. Next, Hans is in a big business. Again, you can ignore this for now. See, we will come back to it if at all there is an information from there. If there is no information required, then I will not come back and do again. Okay, I will not read that. That is waste of my time. Alright. So, on 1st April, Hans Limited entered into a loan agreement with a bank. Loan is repayable in 5 equal annual installments starting from 31st March. One of the loan covenants is that amount equivalent to 50% should be contributed by the promoters by 20th Feb, failing which the loan becomes payable on demand. In anticipation that the company may not be able to mobilize the promoter's contribution, it approached the bank on 15 January and got the compliance date extended up to 31st May for getting promoter's contribution. So, dates have not been given here. And here also they have not given the dates. Okay. Now, how do we know on which date has the financial statement been approved? Okay, that is a very important part in this particular question. On which date the financial statements have been approved, that is not given here. Now, they have approached the bank and got the compliance date extended up to 31st of May. So, what does this mean? 31st May they have got it extended. So, we will assume that on 15 January itself it has been extended. So, the condition is no longer there as on 31st of March, means this is a non-current liability. So, the classification will be non-current financial. Please be careful, it has to be non-current financial liability only. Then, this again has appeared in the question. Hans Limited entered into a, this has appeared in the examination. Hans Limited entered into a transaction to purchase 1000 grams of silver on 15th of Jan. They provide for a price payable which is equal to market value of 1000 grams of silver and shall be settled by issuing such number of equity shares as is required to settle the aforementioned transaction at a price of 100 per share on 15th of April. So, what have they done? They have agreed to buy 1000 grams of silver. At what value? It is not fixed. What they have said, such number of equity shares to settle the transaction at a price of 100 per share. So, equity share is 100 per share. Grams of silver is fixed. Is the value of silver fixed? Not fixed. The value of silver will change. If the value of silver changes, equity will also change. So, what kind of transaction is this? This is a financial liability because the number of shares are not fixed. Now, is it a derivative or non-derivative? That is one thing we have to see. Now, please understand, it changes because of the value of underlying. No or initial net investment is also nil. So, that meets the definition of derivative and hence it will be classified as derivative financial liability. We measure it through FVTPL. So, option B is the correct answer. Then, Hans Limited acquired 100% equity and voting rights of MNO, a subsidiary of Property Investment Group. It paid 600 lakhs in cash and issued 1 lakh equity shares of the face value 100 each at a fair value of 185 per share. to the selling shareholders of MNO. MNO owns 3 investment properties. Fair value of the said properties are estimated to be 700 lakhs. The properties are single tenant industrial warehouses subject to long term leases. The leases oblige MNO Limited to provide basic maintenance and security service which have been outsourced to third party. Administration of MNO was carried out by executive of its parent company on a part-time basis, but the said executive does not transfer to the new owner, and the financial statement are ending on so and so date. Now here the question that we have to understand is whether it should be classified as a business purchase or business combination or an asset purchase. Now what you need to understand here is whenever it has to be a business combination, there has to be input, there has to be a process, output may be there, may not be there. Okay, input and process has to be there. Process has to be substantive. Now here what are the resources of input? Properties. Basic management is given, which is anyways outsourced to outsiders, and the executive who deals with all of these things, that person is also not getting transferred. So process part is completely missing here, and hence we should classify that as a part of an asset purchase. Okay, you can also do the asset concentration test, but that is again optional. Okay, but looking at the substance of the transaction, it is a investment property with tenants and all, so it is more like a purchase of investment property, not a business combination. Case scenario 24, a small case. A Limited engaged in business of manufacturing of a number of products including molds, dyes and machinery. They have wide customer base both within India and abroad. Typically a contract is entered into for sale of each product and consideration is received on the event of delivery of goods to the customer. Cost of each mold is 400 and the selling price is 450. Terms of the contract entitle the customer to return any unused molds within 30 days and receive a full refund. The company estimates that cost of recovering the mold would be immaterial and the returned mold can be resold at a profit. Company has sold a total of 10,000 molds during the month and it expects 3% of the molds will be returned during the current year. Okay. Now the consideration received from the customer is fixed, variable and fixed. There is no consideration. There is a consideration, but here the customer can refund. So whenever refund is there, it is more likely a variable consideration. Upon the transfer of 10,000 molds, the entity will recognize revenue for how much? See, 10,000 has been transferred, so we expect 3% to be returned, so 97% will be recognized, so 9,700 molds. Entity recognizes a revenue of how much? 9,700 into 450, 436, 500. The entity recognizes a refund liability of minus 45 lakhs if I do 1,35,000. So that is the refund liability. Again 450 is the selling price into 9,700 sale, 450 into 300 refund liability. Entity recognizes a return asset. So return asset will be at cost. Cost is 400. 400 into 300, 1,20,000. So that is the third option. And the journal entry will be what? Okay, so journal entry will be A, B, C, D. They have given 3. So revenue we know has to be how much? Revenue has to be 4365. So out of this revenue, this is out. Option A is out because revenue is wrong. B is there, C is there, D is there. So D is also revenue. So this option is correct. Here you have not given refund liability. So refund liability also has to be recorded. So option D is the correct answer. Simple and straightforward. Next one. All Limited holds 35% of total equity shares of M Limited, an associate company. Value of investment in M Limited on 31st March is 3 crores. In the CFS of All Limited, they sold goods worth 3,50,000 to M. Cost of goods sold is 3 lakhs. Out of these goods, 1 lakh to M were in the closing stock of M Limited. Goods costing 1 lakh to M Limited. So yesterday also we did this, right? M Limited declared a dividend of 75 lakhs to the equity shareholders during the year ended 31st March. Statement of P&L showed a profit of 1.5 crores. So here to quickly calculate, what we can do is this we already know 300. So 300 is the original cost. Okay. Then this All Limited sold, the investor sold to the investee. So when All Limited sold goods to M Limited, cost of goods sold is how much? 300 lakhs. Goods costing 1 lakh is still lying there. 1 lakh not out of 3 lakhs, 1 lakh out of 350. So 100 out of 350 is still lying, and the profit we made was 50, right? Goods costing 1 lakh to M Limited. Okay, I am just re-ensuring that we don't do a mistake there. So, how much is this? Divided by 350 into 50. 14.2857. 14.2857. Okay. Then they declared a dividend of 75 lakhs and the profit is 1,50,000. So, net increase will be in the investment value will be 75 lakhs into our 35% share. Here again into 35% you have to consider. Share of all limited post acquisition profit. Share of all limited post acquisition profit is how much? Now, post acquisition profit is how much? 1,50,000. 1,50,000. So, 150 lakhs into how much? 35%. So, that is 5 to 5. So, sharing is 5 to 5. Unrealized gain on unsold inventory for all limited 14,285 into 35%. 14,285 into 35%. If you do, you get 5,000. So, this is the correct answer. Share of all limited in the dividend declared, that you can calculate 75, half of this, 52 ka half. So, 2625. Value of investment we have already computed, and what is the approximate gross margin on goods sold by all limited to M limited? Gross margin on goods sold. What is the gross margin? Gross margin is 50,000 divided by 3,50,000, 14.28%. So, 14.28% or 14.29% is the answer. Okay. This you can calculate directly. What you have to do is you have to ensure you eliminate 5,000 of unrealized profit. Okay. We have already done it, so I am not repeating it again. Next. So, long case. Value of shares, fair value of investment, amount of revenue to be measured, capitalization rate, total amount of borrowing cost to be capitalized, total amount of borrowing cost and general borrowing. So, 3 standards mixed together and given as a single case scenario. Alright. So, it is a diversified book, diversified business entity, multiple segments. So, this is okay. We will start here. A Limited owns 250 ordinary shares of X Limited, an unquoted company. They have a total share capital of 5,000 shares with a nominal value of 10. X Limited after tax maintainable profits are estimated to be 70,000 per year. An appropriate PE ratio determined from a published industry data is 15 before lack of marketability adjustment. A Limited management estimates that discount for lack of marketability of X Limited share is 20%. A Limited values its investment based on earnings. What is the first question? What is the value of shares in X Limited? Okay. Now, when you have to do the valuation of shares in X Limited, 70,000 is the profit, right, divided by 5,000, or what they have asked us? They have asked us total. So, we can do total basis also. 70,000 is the earnings into 15 is the price earning multiple, 10 lakhs, how much? 50,000, alright. Out of this, we have to give 20% discount for what? For lack of marketability, minus 20%, we get 8,40,000. Okay. Now, what is the question? What is the value of shares of X Limited? They have not said of A Limited. Total value of shares of X Limited is how much? 8,40,000. Per share will be divided by 5,000, per share will be 168 and our share in that will be 42,000. Fair value of A Limited investment. So, 8,40,000 divided by 5,000 into 250, we get 42,000. By what amount revenue? So, revenue let us see. A Limited has a telecom segment. It entered into an agreement with B Limited, engaged in generation and supply of power. Agreement provided that A Limited will provide 1 lakh minutes of talk time to employees of B Limited in exchange of getting power equivalent to 20,000 units. A normally charges 0.5 per minute and B charges 2.5 per unit. What is the question? By what amount should the revenue be measured by and recognized by A Limited? So, A Limited has to measure revenue. What is the service they are providing? A is in telecom. So, they are providing 1 lakh. They are providing 1 lakh minutes of talk time. And what they are getting? They are getting 20,000 units of power. Now, always remember, in PPE, we use fair value of asset given up. But when that is when I am buying. So, when I am buying, I will ask, what am I giving? That is relevant. When I am selling, what is relevant? What is the consideration I am receiving? So, what is the consideration I am receiving? I am receiving a consideration of 20,000 units of power. Okay, 20,000 units of power. So, 20,000 units of power and into 2.5. So, what is the number? 20,000 into 2.5, you get 50,000. So, option 50,000, option number D. I hope it is clear. Okay. Then, what will be the capitalization rate for borrowing cost? Okay. So, let us see what have they done. Okay. They began construction of a new building, cost of 7 lakhs, finance the construction, specific loan of 2 lakhs from a financial institution at 9%, other loans are 7, 9, 12 and 11. Okay. Now, what is the capitalization rate? For capitalization rate, if you have to do it on calculator, very simple, 7 into 12% M plus and 9 into 11% M plus MRC if you do 1.83 divided by 16 lakhs if you do, you get 11.4375%. 11.4375%. Or if you want another way is 12 into 7 by 16 and 11 into 9 by 16, this also you can do. Okay. So, that is there 11.43% straightforward. Alright. What is the total amount of borrowing cost and specific borrowing? So, specific borrowing is when did they borrow? They borrowed 2 lakhs, they did not say which date, 1st April, 2 lakhs at 9% and construction of building was completed by 31st of January. So, 10 months. So, 10 months means 2 lakhs into 9% divided by 12 into 10, you get 15,000. So, 15,000 is the answer. Total amount of borrowing cost on general borrowing. Now, they have not said total amount to be capitalized or total amount to be expensed. Okay. So, total amount of borrowing cost on general borrowing, assuming we do only for 10 months, so let me just try 16 lakhs into 11.4375% into 10 divided by 12, if you do we get 150 to 500. Achha, they are expecting borrowing cost to be capitalized. Okay, so they are not, as this is total amount of borrowing cost on general borrowings to be capitalized. Okay, that is what is the question. So, to be capitalized means how much? The expenses are given as 1 lakh 50, 2 lakhs, 3 lakh 50 and 1 lakh. Now, this 1 lakh 50 is from specific. First, we will assume specific usage. Okay. Then, out of this 2 lakhs, we borrow 2 lakhs of specific borrowing. Out of that 1 lakh 50 is used here, 50 is left over with us. So, out of this 1 lakh 50 is general, here 350 is general, here 100 is general. Okay. And we will assume expenditure incurred at the beginning of respective month. Okay. So, 150 into 11.4375% into August means August, September, October, November, December, January, 6 months, 6 by 12 into 11.4375 into October, November, December, January, 4 by 12. This is into 1 by 12. Okay. So, like that if you calculate 150 into 11.4375% into 6 divided by 12 m plus 350 into 11.4375% into 4 divided by 12 m plus 100 into 11.4375% into 1 divided by 12 m plus MRC. Sorry, I made it 0. So, same calculation is here. 150 into 6 by 12, 350 into 4 by 12, this is 1 by 12 and all this put together is what is the answer. Okay. 22.875. Next is related to related parties. So, let us see one by one. Is a globally diversified business and all. Okay. H Limited holds 12% of voting rights in Z Limited. Z Limited board comprises of 8 members and 2 of these members are appointed by H Limited, casting significant influence. Each board member has 1 vote at a meeting. Now, what is the standard rule? 20% we need for significant influence. But here voting is 12%, but by way of board of members, they are able to exercise significant influence. So, H and Z, the relationship is Z is an associate of H Limited. Z is an associate of H Limited. Alright. Why? Because there is significant influence. Sir, 20%, less than 20%, still then there is a significant influence. Then H holds 10% of voting power of G, balance 90% of voting power is held by 9 other investors, each holding 10%. Okay. Then the decision about the relevant activities except decision about taking borrowings of G Limited are taken by members holding majority of the voting power. Decision about taking borrowings are required to be taken by unanimous consent of all the investors. Further, decision about taking borrowing are not decisions that most significantly affect the return of G Limited. So, H Limited is holding 10% of voting power of G Limited. Okay. Balance 90% is held by 9 other investors, each holding 10%. Decision is taken by members holding majority of the voting power, and the decision about borrowing is taken by unanimous consent. However, unanimous consent, that voting borrowing is not very relevant. So, there is no joint control, that is very clear. Now, we have to see what are the options. What is the relationship between G and H? What is the relationship between G and H? G and H, 10% voting power, nothing else is given. Is there anything else given? Nothing. So, G Limited is a subsidiary of H Limited, not possible. Associate, joint arrangement is also not possible. H has invested in G with no further relationship as subsidiary, associate or joint venture. So, here is there anything that indicates significant influence? 10% does not give us significant influence, correct? And 9 investors, each of them hold 10%. So, it is very unlikely that H Limited will be able to exercise significant influence. So, here it is a normal investment and there is no further relationship between these 3 entities. What is the relationship of Y and H? H Limited is engaged in the business of pharmaceuticals. It has invested in the share capital and is holding 15% of Y's total voting power. So, H holds in Y 15%. Y is engaged in the business of producing packing materials for pharmaceutical industries. One of the incentives for H Limited to invest in Y Limited was the fact that Y is engaged in the business of producing packing material, which is also useful for H. Since last many years, 90% of the output of Y Limited is procured by H. In the third scenario, you can see H has 15% in Y. Okay, H has 15% in Y and 90% of the output is purchased by H. So, because I am buying significant amount of output and also have 15% stake, I will be able to influence Y. So, in this case, Y Limited is an associate of H Limited. Associate, how with 10% they can exercise significant influence? I don't think that is a correct conclusion, because see, borrowings are taken unanimously, but they are not that most significantly affect the returns of G Limited. So, borrowing is not one of the relevant activity. Apart from that, we have only 10%. In my opinion, it should be a normal investment, but I don't know, they believe that it is an associate, but I don't concur with this explanation. Okay. Point A, point A, point B, point B, point C, determine the tax rate. So, for each one of these, they want us to calculate the tax base and the tax rate, whatever is there. Joy Limited wishes to calculate the tax base of its liabilities and defer tax as on 31st March of year 5. Balance sheet has been adjusted by current tax expense, extracts of equity and liabilities are given below. So, you have share capital, profits, revaluation surplus, government grant liability for product warranty cost, opening defer tax liability, trade payable, healthcare benefit and current tax liability. Government grants are not taxable. Government grants received in year 4, year 5 is appearing in the balance sheet. So, government grants are not taxable, alright. Now, when government grants are not taxable, then what is the question? With respect to point 1, determine the tax base of government grants for the year 4, year 5. So, because they are not taxable, the tax base is 0, okay. So, nil. Determine the deferred tax on government grants for year 4, year 5, again, okay, it is not that deferred tax expense or deferred tax liability. What are we saying? We are saying what is the deferred tax closing balance. Now, because deferred tax is not taxable, the tax rate becomes 0, that also you can understand. So, determine the deferred tax, nil, DTA, DTL, deferred income, government grant will not be taxable. So, deferred tax impact is 0 and they have given option D also, either A or D should be the answer. So, let us see what is the answer. D. So, because it is excluded, DTA is 0, it should be nil, no. They have said also. Confusing questions. If you see deferred tax, it is nil, this also is correct. So, D is what they have marked. Okay. Then, year 4, year 5, Joy Limited made a further provision for product warranty of 5,000. Such provision are not tax deductible. The warranty settled were 6,200. Okay. So, warranty cost is 16,000 plus 5,000, 21,000. Okay. And they paid 6,200 minus 6,200 is paid. Unpaid is 14,800, alright. With respect to point B, determine the tax base of liability for product warranty cost. Now, what is the tax base? This nil, because in tax, whenever you pay, you get the claim. So, there is no tax base of any liability for tax purpose. With respect to point B, determine the deferred tax liability for warranty cost for the year 4, year 5. Means year ending 4/5. What is the liability cost? 14,800 into 32%. Okay, sorry, my mistake here again. 21,000. Here what we see, 16,000 that we see. This is after payment and deductions. All right. So it will be 16,000. This is wrong. It is already adjusted. If you see the options also, you will not find that option. So 16,000 is the closing balance after making provision and after the settlement, and tax base is 0. So 16,000 is in the books, extra liability. It is a loss into 32%, 5120. So 5120 deferred tax asset. Also, again, calculation is not needed because there will be a DTA, it will not be a DTL. Option D and option E are incorrect. With respect to point C, determine the temporary difference as per Ind AS 12 on account of healthcare benefit. Okay, what is point C? They introduce healthcare benefit. Expenses are allowed only when they are paid, but such liability is recognized when they provide service. Okay, so how much did we recognize? We recognize 70,000. Tax purpose 0. So what is the tax base? 70,000. And what is the deferred tax impact? Because it's an expense, it's a loss, it has to be a deferred tax asset. So this option is gone, this option is gone. Option C will be the correct answer. 70,000 into 32%, if you do, you get the right. Let's look at the next one. Again, a lot of information. So what is the requirement? Financing activity, which cost should be included in the financial report, and so each one is different, independent. Okay, so let's see. Diversified, okay, no problem. Central finance team has been working, okay, no problem. B Limited, one of its subsidiaries of A Limited, reported net income of 25 lakhs, which equals to the company's comprehensive income. The company has no outstanding debt. Following is the information from the comprehensive balance sheet. Share capital, further issue of equity shares, retained earnings, total shareholders equity. Okay, now what is the question? With what cash flow should B Limited report as financing activity in the statement of cash flows? So the question is about what is the cash flow from financing activity. Okay. Now, when you see financing activity, they have given equity shares, further issue, retained earnings, total shareholders equity, and they have made earnings of 25 lakhs. So 100 to 140, so 40 lakhs is the issuance. That is very clear. Are there any erasing of debt and all? They have not given. They have said no outstanding debt, so no problem. Retained earnings, if you see, 100 became 115. What is the earning? 25. So 100 should have actually become 125. It is 115. What could have happened? Bonus issue not mentioned. So at the most, dividend. So 10 lakhs of dividend paid. So what are the options? Issuance of equity 40 and dividend is 10 lakhs. See directly. Once you know this 40, this is automatically done. No need to acha. All options have dividend of 10 lakhs. So we should not have calculated itself. Alright. Then A Limited operates in travel industry and incurs costs unevenly throughout the financial year. Cost of 40 lakhs were incurred and staff bonuses are paid at the year end based on sales. Staff bonuses are expected to be around 400 lakhs. A sum of 60 lakhs would relate to period ending 30th September. So 60 and 40, that should be the answer, straightforward. Advancing cost 40 and staff bonus 60. So option D is the correct answer. What will be the annual depreciation charge on equipment X for year 3 to 10 and the amount of revaluation surplus that can be transferred to retained earnings annually? Okay. So let's see what happened. An item of equipment was acquired on 1st of April for 1 lakh, life of 10, asset was depreciation SLM, revalue to 1,04,000. So 1. Now see, 1 means 2 and 3, only 2 years. We may think 3 means 3 years. No, it's only 2 years, 1 and 2. So balance is how much? 80,000. So how 80,000? Out of 1 lakh, 10 years, 2 years are gone, 8 years are left. So balance is 80,000. And revalue to how much? 1,04,000. So 1,04,000 minus 80,000, revaluation surplus is 24,000. Depreciation will be this divided by 8. 8 years are left, no? So 104 divided by 8, this will be 13,000. 24,000 also divided by 8, 3,000 you will transfer to your from retained earnings reclassified. Okay. So let us see the option. Annual depreciation charge will be 10,000? No, because it is an original cost. Annual depreciation charge of 10,000? No. Depreciation charge of 13,000 and 3,000 may be made. Annual depreciation charge will be 13,000. Transfer to retained earnings is not permitted. Wrong. So see, now here again here. I would not be required to calculate also, because I know after evaluation 1 lakh divided by 10 is incorrect. So, option A and option B are anyways ruled out, and option D is ruled out because it says it is not permitted. There is no restriction. You can transfer. So, option C is the correct answer. With respect to point 4, what is the tax base of intangible asset? What is point 4? A Limited spent 15 lakhs in developing a new product. The development costs were incurred, are recognized for the purpose of computing, are allowable in full. At the end, company recognized an impairment loss of 75,000. Tax base is what? Tax base is nil. Okay, that's it. Then, which one of the following is appropriate classification of annual payment of 12 lakhs to preference shareholders at year end? So, what is preference shareholders? The company has issued preference shares that are redeemable at the option of the holder 3 months before the end of the year. It was probable that the holders would require redemption. Okay. So, because it is redeemable preference share, it is more like a financial liability. Anything we pay on financial liability, we treat it as an interest expense fully, unless there is a split. Okay. So, here they have not mentioned anything about the split. Previously also they have not mentioned anything about the split. I do not know where did they get this number of 12,000 what they gave. So, it will be an interest expense only, no need of split. Okay. Sir, but what if there is an equity component? Please understand, if it is convertible, then there will be an equity component. If it is redeemable, there will be no equity component. Dividend also are outflow and the principal is also an outflow. So, you will be considering it as an interest expense. Next one. U Limited is engaged in mining, not required. U and F Limited are partners of joint operation engaged in the business of mining precious metal. Entity uses a jointly owned drilling plant in its operation. During the year ended, an inspection was conducted by government authorities. The inspection concluded that adequate safety measures were not followed. As a consequence, a penalty of 50 crores has been demanded from U Limited. It is a part of the joint operation. Okay. Legal counsel of the company has assessed that the appeals may not be useful and the appeal orders will be unfavorable. Out of 50 crores, 30 crores will be reimbursed by F Limited later as per the terms of joint operation. At the year end, actual reimbursement was not received. Now, here I have a fundamental difference of opinion. This is a past exam question. This is a past MCQ question. I have a fundamental difference here, because when you say joint operation, the liability are to be split. Okay, it is not a one of the entity will have liability, another entity will have their share of liability, and as per the standard, we have to recognize respective share of the liabilities, not fully. Okay. Now, you may say, sir, but there is reimbursement is not happening. See, here it is not a third party who is reimbursing. We have agreed that expenses are to be equally met, right? So, and there is nothing given here that the other party will not reimburse. So, first hand accounting should be 25, but in the institute's examination question and also in the what do you call this case studies and all, they have considered that it has to be fully borne by U Limited only. But here if you see, we are not followed by the entity for the mining fields, and mining fields is a joint operation. Okay, that is the logic part of it. Examination may, what is the question? With respect to joint operation engaged in the business of mining, how will the liability be disclosed in the books of U Limited? So, you will disclose as per them provision of 50 crores. If you ask me, we will disclose our share of provision, and the remaining part we will disclose it as a contingent liability. I would have gone with option A. That is as per the standard. Okay, if you understand it logically, but they have been maintaining that it is provision. So, in the examination, please do that only. Okay. Then next one, U Limited has issued 10 lakhs 9% cumulative preference shares. The company has an arrears of 15 crores of preference dividend and includes current year arrears of 1.75. The company did not declare any dividend on equity. They have certain optionally convertible debentures. Okay. What is the question? What is the amount of preference shares to be reduced from the profit and loss for calculating basic earnings per share? We will reduce only current year dividend, which is 1.75 in case of cumulative. Even if dividend has not been declared, you will reduce the current year dividend only. Okay. Then on 1st January, U Limited acquired 30% of shares of T Limited, so it becomes an associate. The investment was accounted for an associate in the consolidated financial statement. U and T have an accounting year end 31st March, they have no other investment. Net profit for the year in the income statement was 0.23 and declared and paid a dividend of 0.1 crore, no other dividends were paid. What amount will be shown as an inflow in respect of earnings from associates? We will only show what? Dividend. Okay. Now, how much is the dividend? Dividend is 0.1 crore. What is our percentage share? Percentage share is 30. Declare dividend of 0.1 crore on 1st of March. So 0.1 into, what is our share? Our share is 30%. So we get 0.03, 0.02, 0.03 crores with respect to earnings. Okay, you will not show the share of profit. All right. Then calculate the amount of goodwill or gain on bargain purchase. Let us see what is the thing. They acquired 60%. Okay, cash consideration is 1 crore and 1.21 after 2 years. Say 1.21 after 2 years means what? At 10% if you discount, it will be 1 today. Okay. Fair value of net asset on the date of acquisition is 3 crores. They are measured at proportionate share of identifiable net asset. Now this I have told you earlier also. For MCQ purpose, 3 crores is the net asset. Our share is 60%. So this is 1.8 and this is 1 plus 1 2. So 2 minus 1.8 is 0.2. So answer is 0.2, 20 lakhs of goodwill. Okay, simple. G Limited has number of business segment. So there are 3 independent things. So let us see. H Limited, one of the recently acquired Indian subsidiary, G Limited. It has to adopt Ind AS for the first time as on 31st of March of year 4, with 1st of April being the date of transition. Okay, so 1st of April 2 to 3 transition, and this for the financial year ending they have to do this. Okay, as of 31st March of year 2, the value of raw material inventories were incorrectly reported due to an error. The amount was significant. So there is a material error. Okay, material error. Now, with respect to H Limited, state whether the error should be reported in the Ind AS financial statement. H Limited shall report the impact of error as a correction to the statement of P&L for the period ended 31st of March of year 3. When did the error happen? Year 2. So no, this is not happened. This is not correct. The correction shall be reflected in a reconciliation, not reconciliation. See, now if there is an error and you have to apply Ind AS retrospectively, you have to do it retrospectively. Impact of correction is significant and shall be amortized. Amortization nahi hota hai. There is no amortization in Ind AS for these kind of errors. First, Ind AS financial statement shall distinguish the correction of errors from changes in accounting policy and report it as a part of reconciliation 1st of April opening balance sheet. That is the correct answer. Then G Limited engaged in software development, enters into a contract to transfer software license, installation service, unspecified software updates and technical support for a 2-year period. They sell the license, installation and technical support separately. The installation service includes changing the web screen for each type of user, so and so. Installation is routinely performed by other entities and does not significantly modify the software. Software remains functional without the updates and the technical support. So I'll give the software, you want take the installation or get it done from outside. So what does that mean? If I am providing that installation service and that is not modifying the software, it is a separate work. The customer is not dependent on me for the installation. So that is a separate work. Without update also it will work, without technical support also it will work. So all of this that I am providing is additional. So there are 4 performance obligation. G Limited sells 20% interest in wholly owned subsidiary to outside investors for 100 lakhs in cash. Carrying value of K Limited net asset is 300 lakhs, including goodwill of 65 lakhs from the subsidiary's initial acquisition. What is the question? What is the gain or loss on sale of interest in the subsidiary? Now here they have sold 20% in wholly owned subsidiary. Did we lose control? No. So if we did not lose control, what we will do? We will recognize cash inflow of 100. 2. Now we will have to bring in an NCI at 60. 300 into 20% 60. Net asset will not change, goodwill will not change. So what is the balancing figure? 40. 40 is the gain. So the gain to be recognized is 40 lakhs. Okay. Next. In a diversified business group operating in multiple business segment, maintains books of accounts and so on, so no need to read. One of the business manufactures sugars and chemical, taken a term loan to buy a certain plant and machinery. The loan is repayable over 5 years. Loan agreement requires maintain a current ratio of 1 is 1.3:1, 1:2. Okay. Debt equity was 0. Again, this is a better term, by the way. 1:1 is bad. Okay. State Bank sent a notice on 5th of April demanding the repayment of loan, and the financial was signed on 10th of May. CFO of ABC negotiated with the bank and ensured to rectify the breach. On 25th April, bank agreed not to recall the loan before this has happened. So non-current. See, there is an amendment, but that amendment is applicable from 1st of April 26 onwards. Financial year starting from 1st of April 26 onwards. Not so. If they have not mentioned these dates, you will assume the previous provisions only. So what is that? You will do it as a non-current financial liability. ABC Limited has inventory of raw material 10,000 and 31st March, carrying amount of 100, current market value is 95, will use to manufacture the component, conversion cost is 130, ABC estimate cost of completion and sale to be 50, selling price of 290. So 290 minus 50, 240 is the NRV, or minus 130 also, no, minus 130 if you see. So, this also you can do 110 or 95 plus 130, sorry 100 plus 130, 230 is the cost you can say, and NRV is 240. So, this is a better comparison. Okay, cost is 230 and NRV is 240, or you can do 110 and 100, that is also the same logic. Achha, there's two questions. In a hurry I mark non-current. How should they classify if they have not negotiated? Current. And if they have negotiated, non-current. Okay, that is important. I just marked without looking at the question only, I marked the answer. So, that should not be done. Okay. Then at what value should the raw material be measured in the books? Now, see, finished goods cost is 230, NRV is 240, being sold at a higher value. So, you will measure at cost only, which is 100. So, you will measure it at 100. What is the number? 10,000 into 100. 10,000 into 100. So, 1,000. Revenue, third one. Sold machinery of 900 to a new customer to get into long term relationship. The term of sale include after sale to be provided next 3 years. Company also sells separately where it buys after the initial warranty period at 100,000. Okay. So, two things are there. Sale of machinery. So, 900 we are selling into 900 by 1000, shortcut. Okay. So, 81, 810. So, 810,000 to be recognized as the year of sale and 90,000 to be spread over next 3 years. No need to even calculate, 900 is not possible. So, 810 is the answer. So, 1,008. Compute the value of specialty chemical division goodwill at the date of classification after remeasurement, closing balance of PPE. So, multiple questions are there. Let us see. DEF globally diversified, okay, that is fine. That next, DEF decided to dispose of the business and current and non-current asset of one of his division related to a specialty chemical business which it had acquired several years ago. Disposal does not involve DEF Limited withdrawing from a particular market sector, carrying value on 1st of June of the assets. So, it is a CGU. So, goodwill 10, 20, 8, 15 and 10. None of the assets of the business had suffered impairment as at 1st of June. They have decided on 1st of June. At the date of inventories and trade receivable of the business were already stated at no more than their recoverable amount. So, this is coming as per Ind AS 2 and this is coming as per 109. DF Limited offered the business for sale at a price of 46.5, which was considered to be reasonably achievable. They estimated that the direct cost of selling the business would be 5 lakhs. The estimates have not changed since 1st of June and DF Limited estimates that the business will be sold at 31st of March. So, there is a case of a sale of a business. Now, if you see what is the carrying amount, 10 plus 20, 30, 30 plus 10, 40, 50, 63 million is the carrying amount, sold at 46.5 minus 5, 41.5. Okay. So, any CGU which is held for sale or group held for sale will be valued at the fair value less cost to sell. So, sale price expected is 36.5 46.5 minus 5, sorry it is. So, that is where we make mistakes in the exam, and I do not like the questions being set in this way. 46.5 is million. So, 46.5 million is 465 minus 5, if you do, you get 460, okay, and here it is 630 lakhs. All right. Now, 630 minus 460, what is the loss, or 63 minus 46, what is the loss? 630 minus 460, the loss is 17.0. 17.0 means these two you will keep. First, you will knock off 10 fully against this. So, what is the first question? Value of goodwill 0. Closing balance of PPE. Now, after 17, 10 is gone, we are left with 7. 7 will be allocated between 20 and 8. 7 will be allocated between 20 and 8. So, 7 divided by 28 into 20, 5 will be allocated here, 2 will be allocated here, this is 15 and this is 6. So, closing balance 15 million, okay, they have not asked for patents. Government provided DEF with a grant of 21 million to assist it in the development of factory. The grant is divided into two parts. 6 million was payment by the government as an inducement to begin developing the factory. No conditions were attached. 15 million of the grant related to the construction of the factory at a cost of 60 million. 60 million is depreciable over the estimated 40 years without adjustment of the grant amount from the cost of factory. Okay. Now, what is the question? With respect to the amount of grant, of 15 million with respect to construction of the factory to be transferred to the P&L loss on account in P&L loss profit and loss account in the year 3-4 is how much? So, 15 million is with respect to construction, and they have said without adjustment of the grant. So, 15 million means 15 million is the grant. How much will be transferred to each year over the life of the plant, which is 40. So, you will transfer 0.375 million. What will be the treatment of 6 million that is received from the government as an independent inducement to DEF to begin the development? 1. The grant related to inducement to begin development can be recognized in P&L? Yes. 0.15. So, all of these are not there. Option A itself is the correct answer, okay, because that is for starting. Once I have started, I can recognize it as my income. Okay. Next, HIZ Limited, individual, small only, is a globally diversified business conglomerate with business operations spanning multiple business segments across various regions worldwide. For maintaining its financial record, the company follows Ind AS. Okay, ignore this. On 1st October, they subscribed to 40 million rupee 1 loan notes of Z Limited. They were issued at 90%, 90% meant at 90%, and were redeemable at 1.2 20% premium on 30th September of year 6. So, 2, 3, 4, 5, 6, 5 years. Interest is payable on 30th September in arrears at 4%. This represents an annual effective rate of return of 9.9%. Its intention is to hold the notes until redemption. Okay. So, they want to hold it till redemption. Now, first question, what would be the initial measurement of the financial instrument at the subscription? So, what will be the initial measurement? Subscribe for 40 million into 1, that is 40 at 90% into 90%, so 36. Okay. Now, one mistake that students do in the exam or where they waste time is because they have given effective rate, cash flows and all of that, they start discounting. See, even if we discount, we may get to the same answer. I am not saying no, but if my transaction price is given and there is no compound financial instrument, my net transaction price only should be the initial recognition amount, that is assumed to be the fair value. Okay. So, here for example, for our understanding, I will just showcase it to you how it happens. And what I have seen in a lot of certified copies, okay, what they do. Okay. Now, what is the inflow? Inflow is 4% of par value. So, 4% of 40 million into 4. 40 million into 4% is 1.6 million. So, what they will say? They will type 1.6 million. Okay. Of course, you will not type it in the examination. I am just telling you how it works. Then that is every year and redeemable at 1.2. So, 40 into 1.2 is how much? 48. Okay, that is the redemption value. So, what is the present value of this? Present value I will just write the present value, that will be faster because not used to working on iPad for this. So, I will just calculate. So, the rate they have said is 9.9%, right. So, 1 divided by 1.099 is equal to 1, 2, 3, 4, 5, 6, 2, 3, 7, 5. .62375 and grand total 3.8. Okay. So, if I do this 1.6 into 3.8 m plus 6.08 and 48 into 0.62375 is equal to m plus MRC. If I do, I get 36.02. If you calculate this, you will get 36.02. And here the options, if you see 40, 37, 38, 36. So, 36 we have, this is the correct answer. Now, the problem in the main examination is when you do this, you will start having rounding of differences. So, my thing to all of you is whenever you have the net transaction price, you will follow the net transaction price. What will be the closing balance of financial instruments on subscription of loan notes as on 31st of March of year 2? So, 36 into 9.9% divided by 2 is equal to 1.782. So, 36 plus interest 1.782 for 6 months, closing balance is 36 plus 137, 37.782. Okay, then clear? I hope it is clear. Then on 1st April, they commenced a joint construction of property. For this purpose, agreement has been entered into that provides for joint operation and ownership. All ongoing expenditure etc. are to be shared equally. It was completed on 30th September, utilization of property on 1st of January. Okay. So, what is the question? What is the nature? Now, joint venture, joint operation, this is not there. Either joint venture, joint operation, it is not a separate entity. You do not have access to net asset. So, it is a joint operation. Okay. Then, total cost of construction of 40 crores. The cost was partly funded by a loan of 10 crores taken on 1st of January. 1st of January, construction was completed on 30th of January, September. The loan carries an interest at annual rate of 10% with interest payable at the end of 31st December every year. Company has spent 4 lakhs on the maintenance. The company has recorded entire amount as investment in joint venture, suggests suitable accounting treatment. Okay. So, now the next question is, what will be the initial cost of PPE appearing in the books of HIJ? Okay. Initial cost is what? 40 crores into 50%, that is 20 crores. Interest is 10%. And 10 crores into 10% is 1 crore. What am I calculating? 1 crore into how many period? When did they start? They started on 1st of April. So, April, May, June, July, August, September, 6 months only. So, into 6 divided by 12.5, our share is 50% into 50%, 0.25. So, 0.25 if you add, answer should be 20.25. 20.25. Calculate the depreciation charge for 31st March. So, 20.25, 25 is the amount of PPE. Life is how much? 20 years divided by 20. So, you get how much? 1.025 divided by 2 is 0.50625, 50625. Okay. So, that is the answer. All right. See, some of these questions if you see with slight conceptual clarity, we are able to, not slight, with good conceptual clarity, we are able to do it quickly, and that should be the target. Long case here, capitalized, calculate cash flow, accounting treatment for the customer legal action taken, amount to be charged to P&L for the production line and the cost of production line to be capitalized initially. On 1st April, company began construction of a new production line in its aircraft manufacturing shed. Cost relating to that are given below. Cost of basic material, list price 12.5 lakhs, less 20% discount 10 lakhs. Okay. Recoverable goods and services tax incurred, but not included in the purchase cost. So, this is not included. So, will I consider? No, I will not consider. Not if it was included, I will reduce. Otherwise, I will not consider. Employment cost of construction staff for 3 months till 30th of June, 1.2 till 30th June, and here it says production line took 2 months to get it ready for use. So, out of this we will take only 0.8 for 2 months. Other overheads incurred during the 2-month period ended on 31st May. This included an abnormal cost of 0.3 lakhs caused by a major default. So, 0.699, 0.6. Payments to external advisor relating to construction 0.5, expected dismantling and restoration cost 2. The production line is expected to have a useful life of 8 years. After 8 years, it is legally required to dismantle. The 2 lakhs included in the cost estimate is the amount that is expected to be incurred at the end of the useful life. Appropriate discount rate is 5% and the rate is 0.68. So, 2 into 0.68, that is equal to 2 into 0.68, that is equal to 1.36. Okay. 4 years after being into use, so first the question was what? The requirement was cost of the production line to be capitalized initially. Cost of production line to be capitalized initially. So, what is, how do we do that? 10 plus 0.8 plus 0.6 plus 0.5 plus 1.36, 13.26. So, from the first part, the capitalization will be 13.26. Okay. Then total amount to be charged to the statement of P&L for the production line for the year ended 31st of March of year 3, and the balance of provision of dismantling cost to be carried to the balance sheet. Now, cost of production line to be capitalized on 31st of May is 13.26. Useful life they have given is 8 years. Useful life they have given is 8 years, right? 8 years. So, 4 years after being brought, see again After having solved and still we missed to read. After being brought into use, the production line will require a major overhaul. So, overall to ensure that it generates economic benefits for the second half of its useful life, estimate cost of overall is 3 lakhs. 13.26 will split into two parts, 10 and 3.26. Okay. And that overall is how much? Overall is 4 years. So, this will be divided by 4, this will be divided by 8. So, 10 divided by 8 into 10 divided by 12, this is 1.042. 3.26 divided by 4 into 10 divided by 12, this is 0.68 plus 1.042, 1.72. 1.72 plus 0.05, 1.77, approximately 1.76 and 1.42. 1.76 and 1.42. Okay. During the year, FX Limited provided consultancy services to our customers regarding installation of a new production system related to aircraft parts. System has caused the customer considerable problems. So, the customer has taken legal action against the company for the loss of profits. The customer has claimed damages of 1.6 lakhs. They consider there is a 25% chance that the claim can be defended, means there is 75% chance that the claim cannot be defended. Legal department further stated that they are reasonably confident that the company is covered by insurance against these type of loss. Accountant feels nothing needs to be provided. So, what we should do? 25 lakhs is the claim, no? 1.6 lakhs is the claim. So, for question number 3, what is to be done? For question number 3, we need to create a provision because 75% chances that we will lose. So, 1.6 lakhs will be recognized and not contingent liability, nothing, no, this is also wrong. See, the insurance company claiming or providing us the cover is a separate asset that we will recognize when it becomes receivable. So, option B is the correct answer. Which of the following items need to be capitalized in determining the cost of production? Line item, no. Recoverable GST, no. Initial cost, yes, but at 1.36. Okay. Flynet's cash flow from operations. So, cash flow from operations, right, whenever we do, I directly ask you to do it in the question itself because there is no further information. Net income after taxes 120 and tax charge for the year is what they have told 15. Now, they have not told us whether they have paid tax, not paid tax, how much is paid, that we do not know. Okay. So, first we will start 120 is net income after taxes. Decrease in account receivable means we have collected more. So, plus 20, this will add, plus 25, plus increase in inventory minus 10, increase in account payable plus 7. Why plus? Because we have not paid. Decrease in wage payable, we have paid extra, minus 5. Profit from sale of land, this profit from sale of land comes from where? That comes from some other head, that is investing. So, minus 2. So, we have net 155. Then tax, deferred tax liability. Now, is this deferred tax liability my cash charge? No, it is not. So, I will add this back, plus 15, 170. Sir, whatever tax is paid, see, they have anyways given net income after taxes. So, we can assume that tax expense is tax paid. So, the answer is how much? 170. Okay. So, no need to do such a detailed working, directly you can do and solve it. Next one, carrying value accounting treatment for correction of issuance of compulsory convertible debentures with more acquisitions, which the following statement is correct, and for share purchase agreement what is to be done. Okay. So, 4 questions are there. Let us see. It is a car manufacturing company. The following details are given. With the intention to expand, HSL has entered into share purchase agreement with the shareholders of FM Limited to purchase 30% stake on 1st of June at a price of 30. As per SPA, HSL has an option to purchase an additional 25% stake in FM Limited on or before 15th of June at a price of 30 per share. Similarly, the selling shareholder has an option to sell additional 25% to FM Limited on or before 15th of June at a price of 30. The decision on relevant activities are made in AGM and extraordinary general meeting. A resolution is passed when more than 50% votes are cast in favor. AGM can be called by giving at least 21 days notice to all the shareholders. So, right now we have purchased 30%, we have option to purchase 25%, right. Now, what is the question? With respect to SPA entered into by HSL Limited, determine the date when HSL gained control over FM Limited. Now, how much of thing we have? 30%. Do we get control over 30%? We don't get control over 30%, right? But there is an option to purchase. So while evaluating control, see my effective stake may be 30%, but while evaluating control, I will see whether I have options which I can exercise, because of which my control will increase. So we have an option at 25% on what? On 1st of June we have purchased, and as per SPA we have an option for 25%. So at any time we want, whether or not we will execute is secondary, we have an option to execute. So the stake becomes 55% and the date of control for this transaction is 1st of June. Okay, that is the answer. Then during the year, HSL issued compulsory convertible debentures (CCDs) on a private placement basis for 100 lakhs. It is convertible into 5 shares at the end of 4 years, and at the date of issue, interest is payable at the rate of 6%. At initial recognition, HSL recognized the liability component of compound financial instrument of 2079. HSL also incurred 2 lakhs in connection with the issue of the instrument. Nature of expense include fees paid to legal advisors, etc. Okay, now what is the question? What will be the accounting treatment of directly attributable expense of 2 lakhs? So if there is a compound financial instrument, we will split between debt and equity. What is the equity component and debt component? 100 lakhs is this, and liability component is 2079. So whatever we incur, right? So what is the thing? 2 lakh in P&L? No. 2 lakh from equity? No. It has to be proportionate. Entire 2 lakh shall be recognized as interest cost over a period of 4 years? No, because there is debt and equity, we have to split. So option C is the correct answer. Option C is the correct answer, we don't need to calculate. But if I have to show it to you after calculation, see 2079063 out of how much? 100 lakhs. So basically can I say 20%? So 2 lakhs into 20.79%. See this 2079 out of 100 lakh means 20%. So 41580, 41581 as interest cost, and balance will be reduced from equity. Alright. Then HSL required 40% stake in NM Limited. It's a different company. As at 1st of January for 8 lakhs and classified the investment in NM Limited as an associate. As at 1st of January, the carrying amount and fair value of the plant and equipment is 3 lakhs and 5 lakhs respectively, remaining useful life of 5 years. From 1st of January to 31st March, profit is 50,000. What amount shall they carry its investment in the books of NM Limited? So first, 40% for 8 lakhs, carrying amount and fair value of plant and equipment, and this is 5 lakhs, okay. Achha, they have not given us total fair value of the assets. So we will assume that there is no capital reserve. 40% stake is acquired, 8 lakh is the cost and profit is 50,000. So 8 lakhs is the cost plus our share of profit 50,000 ka 40%, 20,000, correct, no? 50,000 ka 40%, 20,000, 8 lakh 20, no dividend has been paid, minus fair value change is 2 lakhs. This has a useful life of 20 quarters and we have completed 1 quarters, and of this our stake is 40%. So 2 lakhs divided by 20 into 40%, 4,000, you will reduce 4,000. So 8 plus 20 minus 4, 8 lakh 16,000, 8 lakh 16,000 is the correct answer. With more acquisition at the end of year, HSL has investment in 2 subsidiaries, associate and 1 JV. Which of the following statement is correct in respect of these investment? Alright. So here HSL is required to measure all at cost? No. HSL has an option to account for investment in associate and JV using the equity method and carry the investment in subsidiaries at cost. Okay. But investment in associate and JV, there is, you have to carry it at, what do you call, using the equity method. HSL has an investment to measure either at cost or in accordance with Ind AS 109. HSL has an option to measure all such investment either at cost or in accordance with 109. Option is available for each category of investment separately, subsidiary, associate and joint venture. So here they are saying for each investment either at cost or in accordance with Ind AS 109 in separate financial statement, and here they are saying option to measure such investment at cost or in accordance with 109. So what is the difference? Till here it is same, but after that option is available for each category of investment separately. So that is adding some value. So option D is the correct answer. Alright. So I think I will end here. I have covered so far 48 case scenarios, 1 or 2 we would have skipped in between. So I hope these sessions have been useful, especially the small tips that you could gather when we are doing the session, that would definitely be helpful to you, and I hope it helps in your revision and preparation for the examination. Thank you.